Hello everyone, a very good evening. Welcome to the final marathon for your RBWM JAIIB May 2025 exam. So in this final marathon, we are going to discuss the MCQs, numericals, case studies, everything covering all your modules. So once you join, please mark your presence so that I can know that you are here and then we will start with the session. So this is the final marathon. This is your final step towards your preparation and revision. In this session itself, along with the MCQs, I've also included the explanation. So after the session, you just download the PDF and you go through the points that have been given. You don't need anything else to revise. Good evening, a very good evening. We'll just wait for 2 minutes. Share the video so that your other fellow aspirants can also join. Good evening. Okay, so I hope we all are motivated, we all are confident about our preparation that we will do well in our exam tomorrow. Yes? Are you guys feeling confident about your preparation? Good evening, good evening. Yes, great. That is what we require. Along with the preparation, we also need to have confidence and faith on our preparation. All right? So that when we are attempting the questions, we do not get confused there. We do not have second thoughts about the correct answers. As soon as we see the question, the answer should strike our mind that this is the correct answer, and then we should do it. Underwriting services, all right, I will. Okay, so I think we are good to go. We can start with the questions. So let us begin. Everyone be ready, and I want all of you to be active and answer. Okay, so the first question. The primary distinction between mass retail banking and class retail banking. I know you have seen the same topic so many times, but it is very important. So, what is the distinction between mass retail banking and class retail banking? The mass retail banking targets the high net worth individuals. Class retail banking offers customized products for the high net worth or niche customer segment. Mass retail banking focuses on standardized products, and class retail banking focus on the standardized products. So, which of the following statements are true about the? So, these are the two stages in our retail banking. Two stages, right? You are saying BBS 2 and 3. So we start with the mass retail banking where we are offering standardized products and we are trying to build a broad customer base so that we can generate a stable source of income. And then when we have those customers on board, then we upsell and cross sell. So then we provide tailor made or customized services. So from mass retail banking, we move on to the class retail banking where we serve the high net worth individuals. Next question. A retail bank decides to offer specialized financial services, advisory service, and exclusive wealth management solutions tailored for the affluent individuals. What type of retail banking is the bank likely engaging in? So, the terms that you need to focus on: specialized financial advisory services and exclusive wealth management solutions. Tailored for which class? Tailored for the affluent individuals. So, what are we referring to here? Corporate banking, mass retail banking, investment banking, or private banking? Investment banking is a part of retail banking. We are talking about which type? Yes, private banking. If you remember, class retail banking is also known as private banking. Private banking. All right, class retail banking is also known as private banking. Why? Because we provide personalized, custom-made services to the high net worth individuals. Yes, the correct answer is D. So I've provided the explanation to you. Once we are done with the session, download the PDF. Before going for your examination tomorrow, just go through these points. What is the meaning of retail banking, liability side, asset side, covers all the types of products, credit cards, depository services. Then we begin with a target clientele, and then we go to the class retail banking. All right, and right here it is given retail banking focus solely at the niche customer segment is also termed as private banking. All right, so the characteristics of mass retail and class retail I have included. You get it? How we need to study now? We are practicing these questions, and then after the session, you will go through the theoretical part given in the PDF. All right. Next question. Which of the following factors contribute to the lower credit risk in retail banking? Why is there a lower credit risk in retail banking? Small loans amount reduce risk exposure. Large client base diversifies the risk. Customers can bargain effectively for the lower interest rates. Retail banking is more volatile than corporate banking. So 1 and 2, 3 and 4, 1 and 4 or 1, 2, 3 and 4. So what should be the correct answer? Yes. The correct answer is A. The customer base is quite small and fragmented. Small and fragmented, because of which it cannot bargain effectively. So it will have to accept whatever rates the bank is offering. And retail bank is not as volatile. It is relatively stable as compared to corporate banking. All right. This is again a scenario type question. A bank faces a sudden loss of customer faith due to financial instability, leading to a massive withdrawal of retail deposits. What is this phenomena called? A bank faces sudden loss of customer faith and due to the financial instability. Do we call it liquidity crunch, credit risk diversification, bank run, or deposit shield strategy? What do we call it? Yes, sorry for the delay. Right. So this phenomena is, yes, it is known as bank run. So the correct answer is C. Yes, the correct answer is C. It is known as bank run. All right. So here again, so what are the characteristics of retail banking? The client base here will be large and the risk will be spread across the customer base. The customer loyalty will also be strong, and there will be a good scope for cross selling. Meaning, when a customer has already availed a product from the bank and they need access to another product, they will approach the same bank. So, customer shifting from one bank to another is very rare. It does not often happen. Customers are also too fragmented to bargain effectively. There's a large number of clients which facilitate marketing. All right, now here is the definition of bank run. Any loss in faith in a particular bank can lead to a sudden outflow of retail deposits, resulting in the collapse of the bank. This is called a bank run, right? So when the customers they lose faith, they do not get adequate services, or the bank is delaying in giving a response or providing the service, whatever the case may be, then they will shift to another bank for the same service. So that is known as bank run. All right. Yes. Okay, now this question: which of the following factors contributed to the evolution of retail banking in India? Foreign banks introduced the consumer banking models. Public sector banks initially operated on a generalized approach without customer segmentation. The adoption of retail banking by the public sector banks began in the late 2000s, and the new generation private banks leveraged technology to create new retail markets. So, how did retail banking evolve in India? So, which of the following statements are correct? 1 and 2, 3 and 4, 1, 2 and 4, or 2, 3 and 4? See, if statement you are saying 1, 2 and 4 is correct, then what is the correct statement for the third one? When did the adoption of retail banking by the public sectors began? Public sector banks. In the 1990s. Yes. All right. So this will be the correct answer. C is correct. 1, 2, and 4. 1, 2, and 4. All right. Okay. Then answer this question. In the early 1980s, a bank introduced credit card products that spurred the retail banking space. Which bank was responsible for this innovation? Which bank was responsible for this innovation of credit card products? Bank of Baroda, Citibank, Indian Overseas Bank, or the State Bank of India? I'm getting mixed responses. B, A, C, B. But yes, the correct answer is what? The correct answer is Citibank. The correct answer is Citibank. Again, I've given you the whole information. So Retail banking in India can be traced back to the entry of foreign banks. So when we are referring to the foreign banks, we have two names: Standard Chartered Bank and Grindlays Bank. These were the pioneers. Before that, the public sector banks were using the generalized approach. They were offering the same products, mostly catering to the business class, to the corporate class, right? And there was no such demarcation of the retail and non-retail activities. Then the foreign sector banks, they came in India with their personalized approach, personal banking. So Standard Chartered Bank and Grindlays Bank. Then if we are talking about the credit card products, then Citibank. Citibank created waves when in the early 90s. If we talk about the Indian banks, then State Bank of India, Indian Overseas Bank, Bank of India, Bank of Baroda, and Andhra Bank. These were the early players. All right, but the evolution of credit card, this started with Citibank. All right, yes. Okay, so now let us move on to the next question. Which of the following are the characteristics of a strategic business unit? Again, a very important topic. We have repeated this topic so many times. Characteristics of the SBU, departmental approach, which banks follow, which type of approach. This topic is very important. So, autonomous divisions with control over performance factors, focused on product offering and market segment, large centralized units without flexibility, and profit centers which operate independently within a corporation. So, which statements are correct? C, 1, 2, and 4. 1, 2, and 4. Yes. So SBUs, they aim at dividing the business on the line of strategic business unit. These are autonomous divisions, small enough to be flexible, large enough to exercise control over most of the factors affecting the long-term performance. They are defined as profit centers. What is the main aim? Focusing on a particular product and the market segment, right? So these are the characteristics of SBU. All right. A leading public sector bank in Mumbai decides to adopt the SBU approach similar to private and foreign banks. What would it what would be its primary objectives? Primary objectives. So enhance the flexibility and improve control over business performance factors, centralize operations for uniform control access all banking services across all the banking services, operate without segmentation and standardize the banking products, avoid modular strategies, and manage retail banking under one umbrella. So, what is the primary objective if a bank wants to adopt the SBU approach? A? Yes. So, the correct answer is A. Now, if we are talking about which type of banks adopted the SBU, we have the new generation private sector banks. They had set up the strategic business units since the very starting, and they had a very clear focus on the business objectives. Foreign sector banks also followed the same SBU approach, but the public sector banks, they did not follow SBU. They had a rather generalized approach. So if a bank wants to enhance their flexibility, improve control over a particular business performance, then they will adopt the SBU approach. All right. Which of the following statements best describe the departmental approach in banking? Now recall the characteristics that we have studied about the departmental approach. It divides banking functions based on specialized departments like accounting, marketing, and finance. It is commonly followed by the public sector banks in India. It focuses solely on retail banking as a primary business model, and it provides clear autonomy to the smaller divisions within the banks. So, what should be the correct answer here? Which statements are correct about the departmental approach? A, yes. So, A is correct. It does not focus solely. Retail banking is one of the business that will be followed under the same organizational structure, and it does not provide clear autonomy to smaller divisions. No, what we do, we create the departments. Separate departments are created on the basis of the functions that they perform, not as a separate business model, but as functions. Yes, A is correct. Okay. Good evening. Good evening, Gopal. All right. So again, characteristics of the departmental approach: rather than dividing on strategic or business lines, organization is divided on the basis of functions the various team perform. So it is a specialized functional approach within the organization, not something which is out of the organization. Right? So we divide the organization, segregate the functions into the various departments like accounting, marketing, finance. Every department has its own manager and the chain of command. Right? We have a more general approach as compared to the SBU. So which type of banks generally follow the departmental approach? The public sector banks. The public sector banks. All right. Next. Okay. A small retail bank is considering an integrated approach to reduce risk and improve its profitability. What key strategy is likely involved? Implementing separate divisions for retail banking based on customer segmentation, following the departmental approach where retail bank is structured by function, avoiding a focused approach on retail banking, treating it as secondary, unifying the different banking segments to optimize the operational efficiency. So this small retail bank wants to consider the integrated approach. So what is the key strategy that will be involved? The key strategy involved. D, D, yes. This is the characteristic of the integrated approach, usually adopted by smaller businesses, combines all socioeconomic aspects, adopts a cohesive approach to tackle the problems of the business, and it assumes having a unified business that would reduce risk, increase profitability through scale. All right, so having a unified business approach, that is what integrated approach is about. All right, next. A foreign bank launches a full-fledged retail banking model in India with aggressive branding and credit products. After a few years, it finds that retail banking is not profitable and decides to exit. What does this scenario best exemplify? So we already know that foreign sector banks, they go with profit motives, not by any product positioning or aggressive marketing. Rather, they go with the product that is more profitable. And if they do not find it profitable, they will either exit the segment or the complete business model. So what does this scenario best exemplify? Modular adaptation in the retail banking strategies, brand repositioning for the long term retail growth, strategic decision making based on the business viability, Standard retail business model followed by all private sector banks. Right? Hmm. So, strategic decision making based on the business viability. If they see that a particular business is making profit, they will enter and they will exit if it is not profitable. We have the example of BNP Paribas, other banks which entered, and for example, the credit card business, right? So, these are the examples of the foreign sector banks. Okay. Which of the following statements accurately describe the positioning approach of the banks in retail banking? How do they want to position themselves in the market? The old generation private banks align their strategy with their overall business plan. New generation banks, they leverage technology with aggressive strategies for the top tier positioning. Foreign banks focus primarily on brand building rather than profitability. Foreign banks make strategic exit decisions if the retail banking segment is unprofitable. Again, I think this is also very simple. So, if you remember the positioning objectives, new generation private banks also have positioning approach, old generation as well. Public sector banks, they go by the product and customer offering, and foreign sector banks, what they do is they focus on profit and business. So the correct answer is C, 1, 2 and 4. 1, 2 and 4. All right. So in case of the old generation private banks, the positioning platform is clear. They have a very aggressive positioning platform. They want to be in the top slot across all the class of banks. But foreign banks, they do not go by positioning objectives, but purely on the business objectives. They go by customer, business, and profit targets. They take a call on the business model itself. If it is not profitable, they will exit the retail banking segment or a particular business line within the particular model. All right. Now we have the concept of the horizontally organized and the vertically organized models. So, which of the following accurately describe the horizontally organized models in retail banking? It follows a modular structure using different process models for different products. Customer information is stored in a centralized database across all the products. Banks offer end to end solutions product wise rather than customer wise. It enables cross selling and upselling through the centralized customer data. So, the characteristics about the horizontally organized model. Again, we will recall the scale that we had prepared. On the extremes, we have the horizontally organized and vertically organized model. In between the extremes, we have predominantly horizontal and predominantly vertical. This classification depends on what? It depends on how the customer data is used. Whether we are using a centralized customer database across all the products or we are using a separate process for each of the product. So when we are using a centralized database, then we are having the vertical approach, the vertically organized model. And when we are using different process models for the different products, we have the horizontal model. All right. So it follows a modular structure using different process models, and banks, they offer end-to-end solutions product wise. So the correct answer will be B, 1 and 3 only. Cross-selling and upselling through the centralized customer data, that goes with the vertically organized model. If we are talking about the predominantly, then predominantly horizontal, for most of the products, we are using end-to-end processing. For some of them, we'll be using a common centralized customer database. On the other hand, for the vertically organized, for most of the products, we are providing solutions through the centralized customer data, and for some, we are using end-to-end processing. Okay. Again, after recalling the definitions, we can easily answer this question as well. So, a bank aims to maximize cross-selling and upselling opportunities by ensuring customer information is available across most of the products. Most of the products. Which process model would best achieve this goal? Predominantly vertical, predominantly horizontal, fully horizontal, or fully vertical? Where the information is available across most of the products. No, when you are answering B, predominantly horizontal means for most of the products we have end-to-end processing. For most of the products we have end-to-end processing. But here we are saying that we have customer information across most of the products. For maximum products, we are having the centralized. Yes. The correct answer is not B. The correct answer is A. Predominantly vertically organized. Understand the meaning of predominantly, mostly. For maximum of the products, we have the common information across, which is available across the products. Huh, right. A is correct. Okay. And when we are referring to the predominantly horizontal model, then for maximum products, we have end-to-end product offering. But for some of them, we will be using a common customer database. Clear now? Do not get confused. You already know this topic. We have studied so many times. Take your time. Don't be quick to answer. Take your time, understand what is given in the question, and then answer. All right? Does anyone still have any confusion in these four models? Or is it clear? If you want, I will explain it again. Or else we will move forward. Clear? All the four models are clear? All right. Okay. So I think we can go to the next question. So again, I have given you the definitions. The horizontally organized model uses different process models for the different products and offers end-to-end solutions product-wise. We go product-wise, right? In the vertically organized model, we have functionality across the product, and there is customer database orientation. Centralized customer database is used across products. So let's say I have this customized centralized customer database, and I am using it. I have this database prepared from the home loans that I have offered. If I use it to sell credit cards as well, to sell investment products as well through a subsidiary, then what am I doing? I'm using the vertically organized model. All right. I have gathered data on one product. I'm using it across the products. On the other hand, in the horizontally organized model, I will have separate processing for the home loans, which will not be shared with my credit lines. It will not be shared with my investment product, any third party fee based product. All right. So we go with product wise in the horizontal model and across product in the vertical model. Clear now? And then in between, we have the predominantly horizontal model, which is mostly product oriented. And for some products, we have common customer information. And on the other hand, predominantly vertical model, common information is available for most of the products. And for some, we have separate processing. All right. So if this question comes in tomorrow's exam, don't get it wrong. This is a very simple concept, very interesting concept, and also very scoring. Okay. Then if we talk about the banks, which type of model is approached or adopted by the different banks? So in the public sector banks, I told you that public sector banks are traditional. So they go with horizontally organized model. They are ready to take more time, give more effort, carry on laborious tasks. So they will give separate process model for all the products. They go with horizontally organized or predominantly vertical or predominantly horizontal. In the old private sector banks, the scenario is mixed. The new generation private banks, they follow the vertically organized models because they have better technology, better processes. And in the foreign banks also, we use the predominantly vertically organized model. All right. Okay. Now answer this question. A bank faces challenges in monitoring and recovering the loans due to a large customer base. What type of banking model is this scenario related to? The difference between retail banking and corporate banking. Characteristics of retail banking and corporate banking. So, if the bank is facing challenges in monitoring and recovering loans, then whether it is retail banking, corporate banking, investment banking, or private banking. Again, I'm getting a mix of responses A, B, A, B. Where do we have a large customer base? In retail banking or in corporate banking? A large customer base. We are not talking about the large ticket size of loans. We are talking about the large customer base, which is there in the retail banking, right? There's a large customer base, so monitoring and recovering loans will be more laborious, although the ticket size is low. In corporate banking, the customer base is small, focused only on the entrepreneurial class, the business class. Although the ticket size is more, so the impact of NPA will be more pronounced in the corporate banking. Yes? So the correct answer is A. All right. A scenario is given to you. A corporate client approaches a bank for large value loan but negotiates for lower interest rates due to the size of the loan. What characteristic of corporate banking does this scenario highlight? High returns due to broader interest rate spreads, increased bargaining power of the corporate clients leading to lower loan rates, high concentration risk due to the large ticket loans, small scale lending with mass market products. Option A is 1, 2, and 3. All right, 1, 2, and 3. Answer this question. C, 2, and 3. Right. So, what happens in the corporate side of banking? The customer base is small, so they can bargain for a lower interest rate, right? So yes, increased bargaining power for the corporate clients leading to lower loan rates and high concentration risk due to the large ticket loans. So if out of 10, two customers default on the retail side. Thank you so much, Afreen ma'am. All right. Afreen ma'am is in the chat box, everyone. Wishing you all the best. Hmm. So we are talking about the corporate side. So what happens here? There's a large ticket size. So if out of 10, 2 will default on the loan, it will have a more pronounced impact. It will cause more loss to the bank as compared to when 2 out of the 10 customers they default on the retail side. Right? So the correct answer will be C, 2 and 3. Here are the differences between the retail banking side and the corporate banking side. So retail banking targets are the individual segment. Definitely, definitely, ma'am. I'm very confident about their preparation. Yes. Okay. So retail banking targets are the individual segment. Corporate bank deals with the corporate clients. Retail banking is a mass market where we are giving standardized products to the large customer base, and then we move on to customized products. On the other hand, wholesale or corporate banking looks at the relatively smaller segment. This point is important. Retail banking is a business to customer approach, while corporate banking is a business to business approach. Ticket size is low in retail banking while it is high in the corporate side. Risk will be more widespread because the customer base is also large in the retail side, while the risk will be more on the corporate banking. Similarly, returns will be more in the retail banking because the interest spreads are more. Monitoring and recovering, however, will be more laborious on the retail side. On the liability side also, the cost of deposits will be relatively less. Why? Because we are going with the card rates. In corporate banking, the ticket size of deposits is large. Mostly the deposits which the corporate banking gives is the current account offered to the corporate segment. So whatever collection does the bank do, it will be of large size, and the cost of maintaining it will be also high. However, the impact will be more pronounced in the corporate banking than in retail banking because the ticket size is higher on the corporate side. All right. Next question. Which major reforms occurred during the nationalization phase from 1969 to 1991? So there have been nationalization twice. When we are talking about the three phases of evolution of banking in India, so two phases we have seen nationalization. So you need to answer correctly the reforms that occurred during these phases. Nationalization of 14 banks in 1969, followed by 6 more banks in 1980. Merger of the SBI subsidiaries into SBI in 1959. Privatization of leading banks to encourage market driven competition. Government intervention in the banking aimed at financial inclusion and credit access. So, about the evolution of banking in India. So, we know that prior to independence, there were around 600 banks in India, but most of them have closed down, only a few survive today. And then there were the presidential banks. If you remember, the three presidential banks which were established at Kolkata, then Mumbai, and Chennai. Kolkata, Mumbai, and Chennai. Right? They were merged as the Imperial Bank of India. The Imperial Bank of India when in 1921, and this Imperial Bank of India is now known as SBI. All right, State Bank of India. Later on, the subsidiaries of SBI were merged when in 1959. So these statements are correct about the merging. And I haven't yet got the correct answer. Why A statement is correct, right? Because nationalization of 14 banks in 1969 and then 6 more were nationalized in 1980. These were the two phases of nationalization. The nationalization phase from 1969 to 1991. In 1969, 14 banks were nationalized. In 1980, 6 more banks were nationalized. So one is correct. Option D cannot be true. One is correct. Then merger of the State Bank of India into the SBI in 1959. This is also correct. But what is not correct? The privatization of leading banks. This phase, the privatization of leading banks, this was not a nationalization phase. This was after the Narasimham Committee recommendations. This was after 1991. So the liberalization phase. Liberalization phase based on the recommendations given by Narasimham Committee. Okay, so the correct answer will be B. 1, 2 and 4. 2, 3 and 4 is not correct. Third statement will be wrong. Okay? Privatization occurred after the 1991 reforms. B is the correct answer. All right? Yes, B. Hmm. Another important point that we discussed in the marathon session as well, we know that the banking system is regulated under the Banking Regulation Act of 1949, right? What was the original name of the Banking Regulation Act of 1949? Who can tell? What was the original name of the Banking Regulation Act? And when was it enacted? The original name. Does anyone remember? This act, when it was first, yes, it was when first it came into force, it was known as the Banking Companies Act of 1949. Then later on, the cooperative banks were also included. So the name was changed to Banking Regulation Act of 1949. This change was made when? In March 1, 1966. 1966. Merger of SBI subsidiary happened recently in 2017. We are talking about the 7 subsidiaries. The SBI Mahila Bank, this was merged in 2017, but the 7 subsidiaries that were merged, this was way before. Okay. 7 subsidiaries were merged when? In around 1960s. And then another 5 associate banks. 5 of the SBI's associate banks along with Bharatiya Mahila Bank, this was merged in 2017. Do not get confused. The SBI associate banks that were merged were the Bikaner and Jaipur, Travancore, Patiala, Mysore, Hyderabad. This was in 2017. 7 subsidiaries that were before this merged, that we are talking about. All right. Clear? Karthik? Clear? Okay. Hmm. They were nationalized in 1959, merged with SBI. There were various phases. In 2017, till 2017, the merger happened. Okay, till 2017, the merger happened. They were nationalized in 1959. All right. Okay, next. A researcher is analyzing the banking history in India and finds that three key banks were merged in 1921 to form a single entity, which later became SBI in 1955. Which was not merged? I've already told you this. Three banks were merged to form the Imperial Bank of India. Yes. So the Bank of Madras or Chennai, Kolkata, and Mumbai. These were merged to form the Imperial Bank of India in 1921, and then it was nationalized in 1955 and named State Bank of India. So the correct answer is A. Not B, but A. If sometimes we can refer it to Madras or Chennai, same thing. Okay, Kolkata, Mumbai, Chennai or Kolkata, Mumbai, Madras. All right. So yes, the Banking Regulation Act of 1949 was passed as the Banking Companies Act of 1949. It came into force and then it was changed to Banking Regulation Act 1949 from 1966. These are the three phases of development of banking sector in India. In the first phase, which is the early phase, 1717 to 1969, then we have the nationalization phase, 1969 to 1991, and the liberalization phase from 1991, and it continues till today. About SBI also it is given. The three presidential banks were merged as the Imperial Bank. Later on, it was nationalized and named SBI. The nationalization of 14 banks in 1969, six other in 1980, and then the seven subsidiaries of SBI were nationalized, and then later on, in phases, they were merged with SBI. All right. Which statements accurately differentiate between profit and profitability? Profit and profitability. Profit is the absolute amount of money a business earns after accounting for all the expenses. Profitability is a relative measure that considers the scale and resources of a business. A business with higher profit always has higher profitability. Profitability can be a better indicator of a company's financial health compared to the absolute profit. So, which statements are correct? 1, 2, and 3, 2 and 4, 2 and 3, or 1, 2, and 4? So, when we are talking about profit, it is simply revenue minus expenditure. This is our profit. Every organization, every company's main aim is to generate profit, right? So, it is the absolute number, absolute. But profitability is a relative measure. We are saying how much profit are we generating relative to the costs that we have to incur. So with every additional cost, how much profit am I generating? So profitability is a relative measure, profit is the absolute measure, but always a higher profit does not mean higher profitability. Sometimes a company can be making increasing profit but with very high costs. So the third statement will be incorrect. All right. Profitability is a measurement of efficiency and ultimately its success or failure. It is a metric used to determine the scope of a company's profit in relation to the size of the business. All right. When we are talking about profit, it is the absolute number. The amount of income or revenue above and beyond the costs or expenses. So revenue minus total expenses, that is our profit. Okay. How is gross profit calculated and what does it indicate? Gross profit is calculated as the total sales minus the cost of goods sold. It represents the efficiency of a company's production process. Gross profit indicates the profitability after deducting all the operating expenses. It is the first level of profitability measurement on an income statement. So, which statements are correct about the gross profit? B, yes. Alright, so the first level of profitability is gross profit. Simply, it is the sales minus cost of goods sold. First item on the income statement is our sales. Second item right below it is the cost of goods sold. How do we calculate the gross profit margin? Simply by dividing the gross profit by the total sales. Dividing the gross profit by the total sales. That will give me the gross profit margin. No, not D. D is not correct. The correct answer is B, Pavitra. Okay. Why? Because the third statement will be incorrect. Alright. Which of the following correctly describes the relationship between gross, operating, and net profit? Gross profit is always higher than operating and net profit. Net profit is typically higher than gross profit. Operating profit is calculated after deducting the expenses from gross profit, and the net profit is the residual after all the type of expenses including operating expenses, taxes, and the interest. Yes, the third statement was about operating profit. From gross profit, we subtract the operating expenses to get the operating profit. Sales, what are the operating expenses? S, G, and A. D. 1, 3, and 4. Second level of profitability is the operating profit, calculated by deducting the operating expenses from the gross profit, right? So the operating expenses are what? S, G, and A. Selling, general, and administrative costs. This is also important. The institute can reframe the question: which of the following are included or excluded? Which of the following are excluded when we are calculating the operating profit? Which of the following are deducted from the gross profit to arrive at the operating profit? So, selling, general, and administrative costs. And finally, we have the net profit, income left after all the expenses. And for calculating the operating profit margin, similarly, we will divide the operating profit by the total sales to get the net profit margin. Net profit divided by the total sales. Okay. How does leverage impact a bank's profitability? Banks earn a larger return on equity because of leverage. Leverage involves increasing profits through equity rather than borrowings. Leverage decreases the return on assets for banks. All of the above are correct. How does leverage impact a bank's profitability? So, what is leverage? When a bank increases its liabilities to pay for the assets, it is using leverage. What are the liabilities? The borrowings. So if the bank is using more liabilities to pay for the assets, then it is using leverage. Otherwise, a bank's profit will be limited by the fees that it can charge on the assets. It will depend only on the interest rate spread. All right, so what we are doing, we are using the liabilities. So the correct answer will be A. Banks, they earn larger equity because larger return on equity because of leverage. And no one answered correctly. Why? Let us revise this concept. So what is the leverage ratio? If you remember the leverage ratio, it is the bank assets divided by the bank capital. Right? This is the formula for leverage ratio. Using leverage means that I am generating a higher return on the equity. So what I'm talking about? I'm talking about the return on equity. What is equity? The bank owner's share capital. All right, the share capital. And this is what the banks are primarily interested in. So there are two ways in which I can increase or the bank can increase their profits. Either they can increase their assets, they will increase the rate of interest that they're charging on their asset, or they can increase the fees that they are charging on the various fee based services, but it is restricted because of the RBI regulations. So we cannot increase it beyond the particular level. So what we will do, we will use leverage. We will use liabilities to pay for the assets. All right, so this statement is the very definition about leverage. All right, this statement is incorrect. Why? Because leverage involves increasing the liabilities. Increasing the liabilities. And it increases the return on assets for the banks. All right. So the meaning of leverage basically means that I'm using debt. Leverage means I'm using debt to increase my earnings. Because what are deposits? Deposits are just the money that the bank is going to own the depositors, right? So it is a debt created on the bank. Leverage ratio will be the same as debt ratio. So the return on equity can be increased by increasing the leverage. Okay, do not forget this concept. All right. Yes, so when a bank increases its liability to pay for the assets, it is using leverage. Otherwise, the profit will be limited by the fees that it can charge and the interest rate. But the interest rate spread is limited by what a bank must pay on its liabilities. All right? Okay. Then, what is the difference between return on assets and return on equity in banking, the two traditional methods of profitability? The return on assets measures profitability from assets, while ROE measures profitability from equity. ROA is always higher than ROE in banking. Banks typically aim for a higher ROA than ROE. Leverage can lead to a higher ROE as compared to the ROA. So, which of the following statements are correct about these two measures? B, yes, we have just discussed. Right? The return on assets cannot be increased beyond a certain level. Why? Because it is limited to the extent. The interest rate that can be charged, the maximum has been prescribed by RBI. The fees that can be charged also has been limited by RBI. All right. So we have to increase our equity, the leverage. Okay. So ROA measures the profitability from assets and ROE measures it from the equity. This is obviously true. ROA is not always higher. Banks, they typically aim for a higher ROE, and leverage can lead to a higher ROE as compared to the return on assets. All right, so the correct answer will be B. So, banks, if they want to increase their income, they can increase their assets. But if they want to purchase more assets, they will have to pay it either by more liabilities or with bank capital. If they use bank capital, the bank capital can get eroded. Just even if the bank's assets they fall by a small number, the bank's capital will get eroded. That is what happened with the subprime mortgage crisis. If you remember, the Lehman Brothers crisis. Okay, so the value of the assets, if it drops by just a small percentage, the bank's whole capital will be eroded. That is why we use the ROE. Okay, what factors influence a bank's return on equity? The amount of bank capital, the total value of income earning assets, the fees charged for the banking services, the use of liabilities versus bank capital to finance the asset purchases. What factors are going to affect the level of ROE? For this, if you remember the formula for ROE, the formula is simple: return on assets multiplied by the leverage ratio. Return on assets is what? Net income divided by the bank assets, right? Multiply it by leverage ratio. What is leverage ratio? It is bank bank assets divided by the bank capital, right? Bank capital. So we can cancel out bank assets with bank assets. So the net income is definitely going to impact my ROE. The bank capital is also going to impact my ROE. But the fees charged for the banking services, this has no impact. Right? So the correct answer will be D, 1, 2, and 4. Correct. Yes? So the amount of bank capital is there. The total value of the income earning assets, which is represented by my net income, and the use of liabilities versus the bank capital to finance the asset purchases. Yes, so the correct answer will be D. Okay, let us solve this numerical. Bank A has the net income of rupees 50 crores, fee income of rupees 30 crores, net interest income of rupees 120 crores, and the operating costs of 70 crores. If the average total assets are 4,000 crores, what is the return on assets? Everything is given to you directly. You simply need to use the return on assets formula. Just use the formula. So what is the formula for return on assets? It is net income divided by the average total asset. Net income divided by average total assets. What is the net income? Net income is given 50 crores. 50 crores divided by average total assets is 4,000 crores. Yes, 1.25 will be the correct answer. Right, so just remember the formula. Rest everything, fee income, net interest income, operating cost. This is irrelevant, given just to confuse you. But we will not get confused because we have already practiced these questions. All right, so the correct answer will be D, 1.25%. So this is the formula, divide it and you will get the percentage. All right, any confusion, anyone regarding the formula calculation? Yes, 1.25. Yes, clear, everyone? Okay. Another question. A bank decides to increase its capital from 1000 crore rupees to 2000 crore while keeping the total assets at 10,000 crore. Its net income remains 500 crore. So how does increasing the bank capital affect the leverage ratio and ROE? How does increasing the bank capital affect the leverage ratio and ROE? Let me give you some options, although this is a no option question. So let us say increasing capital increases the leverage ratio. This is option 1. Increase in the leverage ratio and decrease in the ROE. This is option 1. Option B, decrease in the leverage ratio, increase in the ROE. Option C is increase in both leverage ratio and in ROE. And option D is decrease in both leverage ratio and decrease in ROE. So what will happen? Leverage ratio decreases, ROE also decreases. All right. So you are saying option D, option C, both of them increase. Others also please answer. We are increasing the capital, keeping the total assets at 10,000 crores. We are not changing the total assets, we are only changing the capital. We are increasing the capital. So what happens with increase in capital? The leverage ratio will decrease. Yes, the leverage ratio will decrease. Why? Because increasing capital reduces the leverage ratio. Then, second point is the net income remains constant and the again the bank capital is increased. So the ROE will also decrease. So the correct answer will be option D. Both of them are decreasing. Both of them are decreasing. You need not calculate anything. Simply try to understand what the question is saying. What is the formula for leverage ratio? It is bank assets divided by the bank capital. So if this value is remaining the same and the denominator is increasing, numerator is remaining the same, denominator is increasing, so obviously this will decrease, right? The leverage ratio is going to decrease. Similarly, when we are talking about ROE, it is net income divided by the bank capital. Net income divided by the bank capital. So similarly, what will happen? It is increasing. So the ROE will also decrease. Yes. Everyone is clear with the concept? This does not require any mathematical calculation. Only you need to understand the scenario. Okay? Good evening. Jagat, good evening. Yes, clear? All right. So increasing capital reduces the leverage ratio. ROE also decreases, indicating a lower risk. All right. Next, a bank reports total assets of 6,000 crores at the start of the fiscal year and 8,000 crores at the end of the fiscal year. If its total income is 120 crores, what is the ROA? Again, if you remember the formula, you can easily calculate the ROA. Try to solve. Options are also given. So, ROA is what? Net income divided by the average total asset. Average total assets. How do we calculate the average total assets? Total assets at the beginning of the fiscal year and total assets at the end of the fiscal year. So 6,000 plus 8,000, and then we are going to divide it by 2. Why? Because we are determining it at the particular point of time. Yes? Why B? So 6,000 crores plus 8,000 crores divided by 2, what are we getting? We are getting 7,000. Yes, 7,000. And then the net income is given to us 120 crores. So 120 divided by 7,000. What will be the correct answer? What will be the correct answer? Around 1.71% should come, around 1.71%. Huh, 1.71%. So the exact value is not given to us in the options. So we can approximately use either, we should use 1.5% because it is the closest. Okay, we should use it 1.5% because it is the closest. All right. Yes. Okay. A bank experiences an increase in its net interest income, but also a significant rise in the total assets due to expansion. If both figures increase at the same time, what will be the likely impact on the net interest income? So again, scenario is given to you, no calculation is required. So what will happen to the net interest income? It will increase, the net interest income will decrease, net interest income will remain unchanged, or it will become negative, or it will become negative. Both the figures are increasing at the same time. This is the point that you need to focus on. Both the figures are increasing at the same time. Will it have any impact? If yes, then what will be the impact? Yes, the correct answer will be C. It will remain unchanged. Why? Because both of them are increasing at the same time, right? The net interest income is increasing, the total assets due to expansion is also increasing. So what will happen? It will remain unchanged. It will remain unchanged. Not net interest income, but this is the net interest margin. Net interest margin. All right. So if both net interest income and the bank assets are increasing, the net interest margin will remain the same. What is the formula for net interest margin? It is net interest income divided by the average total assets, right? Net interest margin is equal to the net interest income divided by the average total assets. So if both of them are increasing at the same time, so it will remain unchanged. Yes, this is the correct formula. If you want to calculate the net interest income, simply the interest which is received on assets minus the interest that you pay on liabilities. So the interest received on assets minus the interest paid on liabilities. That is the net interest income. What are the assets? Securities and loans. What are the liabilities? Deposits and borrowings. All right, so the NIM will remain unchanged. Clear why C is correct? All right, okay. Next question. How does leverage impact a bank's profitability? Leverage involves increasing the profits through equity rather than borrowings. Banks they earn a larger return on equity because of leverage. Leverage decreases the return on assets for the banks. Using borrowings to fund assets is a form of leverage. So, how does leverage impact the bank's profitability? Does leverage involve increasing profits? Yes. But whether through equity or borrowings? If you answer this question, you can, this particular statement, whether it is correct or not, you can eliminate two options. Hmm. So, leverage means increasing profits using the borrowings. All right, using the borrowings. And leverage does not decrease the return on assets for the banks. So, option B, 2 and 4. They earn a larger return on equity because of leverage, and using borrowings to fund the assets is a form of leverage. Yes, B will be correct. All right, B is correct. Everyone, please try to answer. Even if you get it wrong, no worries. We are discussing the correct answers. Okay. What comprises the major assets of a bank? Very basic question, but again important. So, loans and advances, deposits from the customers, securities investment, vault cash, and reserves with the regulator. What comprises the major assets of the bank? C, D, A. C. All right. Vault cash and reserves with the regulators. This is not an asset of the bank. This is what? This is something that we'll call a liability. All right. It is the part of the total deposits that they have to keep at reserves. The legal reserve ratios. CRR and SLR, right? So these will not be included in the assets. What will be included? The loans and advances and the securities investment. And deposits, they come under the liability. All right. So the correct answer will be C. Hmm. 1 and 3 only. Here you have the explanation as well. Assets are used by the business to generate income. Loans and securities are the bank's assets. But to however, to make loans to buy assets, bank must have money. This money will either come from the own capital of the bank, or it will come from the depositors, or it can also come from other banks or by selling the debt securities. So selling the debt securities are the securities investments. So assets include these things. Okay. Which of the following is not a characteristic feature of retail banking products? Volume driven nature, predetermined qualification features, different approach from corporate loan processing, income generation from financed assets. Not a characteristic feature of retail banking products. Is retail banking volume driven? Yes, because we are catering to the large customer segment. Do they have the retail banking products? Do they have a predetermined qualification features? Again, true, right? For example, a retail banking product on the asset side, a bank approved, board approved policy should be there regarding the loans. Deposit side, again, we have to follow the instructions given by the regulators. So, predetermined qualification features are there. Different approach from corporate loan processing, again, true. Why? Because the corporate loan processing is for the entrepreneurial class. So they are trying to generate profit. But on the retail side, it is different. We are catering to the mass segment. So these three are correct. However, income generation from financed assets, this is not a characteristic of retail banking. All right. Why? Because target customers are generally individuals or a group of individuals. They can be employed or self-employed having a regular income. So the repayment is expected to come out of the cash flows on account of the salary. Banks, they finance or give loans for the purchase of houses, vehicles to the individuals, and these assets do not generate any income to the customers. All right, so income generation from the financed asset is not a feature of retail banking products. The customers, they are taking loan for their personal needs. Personal needs. Corporate customers, however, are taking loans, let's say to start a new venture, anything which is profitable. So they are taking loans for profit generation. Income generation from the finance assets is a characteristic of corporate loans. What about CAM? I didn't understand what you're saying. Krishna, what are you saying? Please, can you clarify? See, different approach from. So we are asking which of the following is not a characteristic feature. Different approach from corporate banking is a feature, right? It is a feature for loan processing in the retail banking. The approach followed by corporate side banking is different from the approach followed by retail banking. So this statement will be incorrect, not a characteristic feature. All right? Okay. Next, regarding the due diligence for retail loans, which of the following are standard practices? Verification of the credit report from the CIC, a mandatory house visit to verify the residential address of the applicant, telephone verification of the individual at their office or business phone numbers, ensuring the applicant has a minimum fixed deposit amount in the bank. Krishna, try to understand what the option is saying. The question is asking which of the following is not a characteristic feature, and this is saying that if we complete the statement, so the retail banking products is a different approach from the corporate loan processing. Join the question. All right. So if it is not a characteristic product, then it will mean that retail banking and corporate banking, the loan processing is same, which is not true. All right, which is not true. So the question is asking you about retail banking, thus D will be correct. Okay, D will be correct. Right, so here what will be the correct answer regarding the due diligence for retail loans? Verification of credit information from the CIC is correct. A mandatory house visit to verify the residential address of the applicant. This can be true, right? Then telephone verification of the individual at their office or business phone numbers, ensuring the applicant has a minimum fixed deposit amount. So this will not be considered. All the other are true. Then how can income generate in the retail bank? Okay, this is clear. Answer is A. Coming back to the previous question. Try to understand. All right. This fourth statement is saying income generation from the financed assets. What are the financed assets of retail bank? Home loan is given by retail bank. Education loan is given by retail bank. Car or auto loan is given by retail bank. Do the customers use these retail loans to generate profit for themselves? Krishna, answer this. Do the customers use the loans that they take to generate profit, or are they using it for personal use? Personal use. We are talking about the characteristic of the loan that is taken by the customers on the retail side. Is income generated from from finance assets? No, right? They're using it for personal use, all right. Then if we are talking about the corporate loans, why do corporate customers take loans? They will take it for some business purpose, business reason, to generate profit, right? They will use it for some business purpose to generate profits. So this characteristic income generation from the financed assets, this will be what? Yes, profit making. This will be the characteristic of corporate banking products. This will be a characteristic of the corporate banking product. That is why option D will be incorrect when we are talking about the features of retail banking. What is the feature of retail banking products? Personal use of the financed assets. Clear? Again, if you still have confusion about option C, then different approach from corporate loan processing, that is on the corporate side. So when we are talking about income generation from financed asset, we are referring to the use that the customer make of the loans. If you are asking how the bank generate income, that is a different side, right? Bank will generate income through the interest that they earn on the loan they give. That is a complete different thing. Do not get confused. All right? Hmm. Okay. Yes. So here the correct answer is A. The bank would like to know if the property developer has a market standing and is prompt in delivery. Banks will verify that the project has been RERA approved. Banks will pre-approve some properties which are processed on priority. Invoices collected from the authorized dealers. All right. So the correct answer is A. Okay. Which statements correctly describe the determination of the quantum of loan in retail banking? The quantum of personal loan is typically 12 times the monthly income of the individual. Vehicle loans are generally capped at 2 times the annual income of the borrower. Housing loans can range from 48 to 60 times the monthly income of the borrower. Margin required varies uniformly across all the types of loans. So, how do we decide the quantum of loans? Yes, answer this question. D. 1 and 3. Hmm. D is correct. So a quantum of loan is related to the product or the income of the individual. It is expressed as 12 times the monthly income if the loan is for some personal expense. If it is in case of vehicles, then 4 times the annual income. In case of housing, then 48 to 60 times. Then the multiples of keeping of the margin can vary from bank to bank between 15 to 30% depending upon the loan or scheme, right? So the correct answer will be 1 and 3. It is not 2 times, 4 times, and the margin is not uniform. It varies across all the types of loans as well as across the banks. So the correct answer is D. All right. Based on the income levels and customer segments provided by the Kellent research, which of the following statements correctly match the income level with the customer segment? So, this research, if you remember, in our customer requirements part, we had the whole table according to the income levels and then the customer segment name. So, answer it. Individuals earning between 2 lakhs to 10 lakh per annum fall under the mass affluent class. Super affluent segment includes individuals with income of 50 lakhs to 400 lakhs per annum. High net worth individuals are those earning between 400 lakh to 4000 lakh per annum. And mass market segment refers to the individuals earning more than 120,000 lakh per annum. So, which of the following market segments are correct? C. Yes, C. Great. All right. So this is the table for your market segment. Individuals earning between 2 lakh to 10 lakh per annum, they fall in the mass market, not in the mass affluent, but in the mass market segment. Then super affluent individuals, these from 50 to 400. High net worth individuals are from 400 to 4,000, and mass market comes between, as we have already seen, 2 and 10. The mass affluent is what? 10 to 50. 10 to 50. All right, so we will remember this classification. This is also important. Okay. Hmm. Which banking services align with the social needs level in the Maslow's hierarchy of needs? Again, a very frequently asked topic. Every time you have questions from this topic, the Maslow's hierarchy. Exclusive banking clubs for the high net worth individuals, educational loans for the higher studies, basic banking services like ATM and debit cards, joint accounts, and family banking plans. So you need to answer for the social needs. So we have the Maslow's hierarchy of needs, the pyramid. 5 levels are there in the pyramid, starting from the physiological needs, the basic needs, then safety needs are there on the second level, then social needs, love and belongingness, self esteem on the fourth level, and finally self actualization. So you need to answer for the social needs in banking products. Social needs. Exclusive banking clubs for high net worth individuals. This will increase my social affiliations, right? What else? Educational loans for higher studies. They can come in my self-esteem needs, right? If I'm willing to take higher education after my employment, or they can also come in my physiological needs. Basic services will come in the physiological needs. Joint accounts with family banking. Again, when family is mentioned, it will come in the social needs. So 1 and 4. I have given you the chart for the needs. All right. So the correct answer will be B, 1 and 4. Who has answered B? No one. You are saying D. D is 2, 3 and 4. Basic services. Basic services will come under the physiological, right? The name itself tells that it is the basic service. Physiological needs. So 3 will be incorrect. If you eliminate 3, you will have only one option left. Exclusive banking clubs for high net worth individuals. What are my social needs? Love and belongingness, right? When will I feel that I belong to a certain class of high net worth individuals? If I get to participate in these exclusive banking clubs, right? So this will increase my belongingness. High net worth individuals, I will feel that I belong there. All right? So 1 and 4. Clear, Sharmila? Clear? Why 1 will be there? Okay. B is correct. All right. Considering Maslow's hierarchy, which banking services align with the highest self-actualization? Yes, 2 will be right. Option B. 2 is correct. 2 is correct. Option B. Statement 2 is not correct. Educational loans for higher studies, this statement is not correct because they come under the consumer loans. Okay. All right. Now answer this question. Okay, you have confusion here. Education loans for higher needs will come under my self-esteem. Right. If let's say I am pursuing higher education, I had completed my bachelor's and due to some family issues, I had to enter into the um, job segment. Later on, I get an opportunity to get a master's and a PhD as well. So this will increase my esteem, this will increase my confidence, my worth will increase, right? So it will come under the self-esteem needs. Self-esteem needs. All right? Okay. Now answer this question. Which banking service align with the highest level? Self-actualization. Advisory services for philanthropic activities, fixed deposit with regular saving accounts, overdraft facility and short-term loans, transactional services like online banking and mobile apps. A, yes. What is philanthropic? It is something which is psychological. If I want to work in the social welfare to promote the welfare of others, that is being philanthropic. Okay, so advisory services for philanthropic activities will come under self-actualization. D is what? Transactional services. Transactional services are the basic services. Basic services will come under my physiological needs. Physiological needs. What else? You are answering B, fixed deposit again will come under the physiological needs. Or they can also come under the safety needs. Safety needs. If I'm planning for the future, so I will create a fixed deposit. Here, self-actualization refers to the advisory services. Here's the table for you. Right. Accordingly, in the physiological needs, we have the basic services. Core savings account, personal accident cover, housing loans. Security or safety needs, yes, recurring and fixed deposit. That was there in the previous question. Life insurance product, tax planning. Social needs are consumer loans, personal loans, home loans, car loans, loans for professional development. Self esteem, special term deposit, term insurance product, second housing. Self actualization are pensioners' loans, retirement, and senior citizen. So you need to understand on your own. These are just some examples. And as you would have seen in the questions, I've given other things. So you need to understand. If any service is very basic, then we are referring to the physiological. If it is something related to safety and security, I want to plan for my future. I will have a fixed deposit account, tax planning, insurance. This will give me safety and security. Social needs will increase my love and belongingness, right? Consumer loans, personal loans, home loan, car loan, what I'm taking for my family and friends, health policies for self and family, investment products like mutual fund schemes. So this is there in the social needs as well as in the safety needs. So you need to understand. You will have to use your understanding which product will fall under which category. Okay, next. In terms of service quality, what does tangibles refer to? Tangibles refer to the bank's ability to perform promised services dependably. Tangibles relate to the bank's willingness to help the customers and provide prompt service. Tangibles encompass the bank's trustworthiness and freedom from risk. Tangibles encompass the bank's physical appearance, facilities, and communication materials. So, when we are talking about the customer requirements about service quality, tangibles is there, reliability is there, responsiveness, assurance, empathy, valuing the customer, providing solutions, understanding the customer. So, when I'm referring to tangibility, these are the appearance, equipment, personnel. Are the bank's facilities attractive? Is my product easy to understand or not? That will be tangibility. All right. Reliability will be ability to perform the promised service dependably and accurately. So the first option is about reliability. Okay. Then, is my credit card statement accurate? This will come under reliability. Responsiveness, whether the bank is willing to help the customer in providing prompt service or not. Similarly, other factors are also there. I think we have it here. Yes. So assurance refers to the competence, whether the bank is able to provide me the promised services or not. Empathy is there, trying to understand the customer, keeping the customers informed in a language that they understand, valuing the customer's business and time, providing solutions, not excuses. All right. Now answer this question. This is a scenario. A customer visits a bank to resolve an issue with their credit card statement, which allows an incorrect charge, which shows an incorrect charge. The bank representative listens patiently, acknowledges the customer's concern, and assures them that the error will be corrected within 24 hours. The representative also explains the process clearly and provides alternatives for faster resolution. Which service quality dimension is best exemplified in this situation? Tangible, the physical quality. We will go to it. We'll go back there. First, answer this question. So, which service quality is given here? Tangibility, reliability, responsiveness, or empathy? D not C. D is what? Empathy. B, C. Okay. Mixed answers. So what is the scenario saying? That the bank is they're listening patiently and acknowledging the customer's concern, and also saying that it will be corrected within 24 hours. Faster resolution. So responsiveness, faster resolution. All right, the bank is giving faster resolution so that this problem can be resolved as quickly as possible. So it will come under responsiveness, right? Reliability is, let's say, if the bank has promised that it will be corrected within 24 hours and it actually get resolved within 24 hours, then it will be reliability, right? Empathy means trying to understand the customer's needs and ensuring effective communication. So empathy will be like approachability and easy to contact. Is the customer easily able to register their complaint? Or the bank, if it is communicating, whether they are using just English or Hindi, or they are using the language which the customer understands, so the local language. Understanding the customer, making an effort to know their needs, that will come under empathy. All right, empathy will mean, if let's say the customer comes and says that, okay, a customer who belongs to a rural segment, they do not know how to use the mobile app. They say that I will be able to use it if it is given to me in Hindi, or if it is given to me in any other local language, let's say Bangla or any other language. Okay, if the bank is giving solution that, right, I am changing the settings so now you can use it in your local language, that will be empathy. Understanding the customer, making an effort to know the customer. Reliability will be when the bank has promised that I will resolve the issue in 24 hours and the issue actually gets resolved in 24 hours. The bank is delivering what they are promising. That will be reliability. Right? So when the officer says that the, let's say, amount will be sanctioned in 2 days, will it be sanctioned or not? Is it actually sanctioned or not? If the bank is giving me a credit card statement, so the credit card is statement is accurate or not? Or are there any miscalculations or misrepresentations? So reliability will be sort of accuracy. Can I rely on the bank for my service or not? All right. Empathy done, reliability done. Clear? You asked about the previous question. The previous question's answer is D. Tangible encompasses the physical appearance, facilities, and communication materials. Physical appearance, is the bank atmosphere attractive or not? The facilities that are there are easy to locate or not? Communication materials, only one-to-one branch communication is there, or mobile app is also there, and AI is there, chatbot is there. So this is tangibility, right? Physical features. Okay. And I've also included everything, the meaning of tangibles, the meaning of responsiveness, reliability. Here you have the meaning of assurance, empathy, valuing the customer, providing solutions, understanding the customer. All right. Next. What characteristics define the introduction stage of a product life cycle? High sales volume and revenue, low sales volume and insufficient revenue to cover the cost, high customer awareness and acceptance, time taken for the product to become known to the customers. What are the characteristics of the introduction stage? You answer, till then I will draw the graph. So here on the x-axis, what do we have? We have time, and here we have on the y-axis sales and profit. So when a product is introduced, it passes through four stages. Stage 1 is the introduction stage. Stage 2 is the growth stage. Stage 3 is the maturity. And stage 4 is the decline. D. 2 and 4. 2 and 4 is correct. Right? So what happens in the introduction stage when a product is initially introduced? The cost incurred to market the product, advertise the product, this will be high, and the income that is being generated will not be enough to cover the cost. Why? Because it has not yet become popular. So the customer awareness and acceptance will be low. High sales and volume revenue, this will be the characteristic of our stage 2 growth stage. High customer awareness, again stage 2. So stage 1 is introduction, stage 2 is growth, stage 3 is maturity where we have the highest profit, and then stage 4 is decline because of increasing competition. Staleness will come in. Staleness and saturation. So now we will have to add value to make our product continue in the market. Okay. What are the features of the maturity stage in the product life cycle? Maximum sales and profit inflow, customer indifference, stagnating business and profits, wide customer base. We have studied so many times about the product life cycle that you can very easily answer these questions about the stages. So now you need to answer about the maturity stage, the third stage. C, B, C. Yes, the correct answer is C. 1 and 4. Hima, you are saying B. B is 2, 3, and 4. Customer indifference is a characteristic of our stage 4, which is decline. Stagnating profits and business is also the characteristic of stage 4, which is decline. Maximum sale is there where in the maturity stage, and wide customer base. So C is correct. Clear? Hmm. Okay, so it is 8 p.m. Do you want a break or shall we continue? Do you want to take a 10 minutes break or we can continue? C is correct. Please reply, everyone. Do you want a break? You want a break? Okay. All right. So let us take a 5 minutes break. Okay. Let us take a 5 minutes break and then we will continue. All right. All right. So are you back? Please confirm that the audio and video is fine. The audio and video is fine. Okay. How long will the session last? I think we'll have to take the session to at least 11. At least 11. You can take break in between, you can join, you can then download the PDF and revise. Okay? So here the answer was C. So I've given you the characteristics of the growth stage, maturity stage, introduction stage, and then the final decline. All right, decline stage, the product becomes less attracted for the customers due to various reasons. This leads to a drop in sales volume and profit. If it is not attended properly, then it will lead to product death. How can we avoid the product death? By adding to revitalize the product and for the continued acceptance. Okay. What are the two types of branding exercises adopted by banks? Product branding and service branding, product branding and corporate branding, corporate branding and customer segmentation, service branding and customer loyalty branding. Which type of branding is followed by the banks? This might seem to be a new concept, but you can answer it. Basically, we are trying to create a USP or a type of brand for our product. So either we will create a brand for ourselves related to the product, or we will create our image as a corporate bank. So product branding and corporate branding will be correct. Yes, B will be correct. All right. Okay, now answer this scenario. A bank launches a premium wealth management product for high net worth clients, gaining traction initially. However, 6 months later, a competitor introduces a more attractive alternative with higher returns and lower risk, causing a slowdown in acquisitions and customer retention. The bank's management debates whether to revamp the product, enhance benefits, or phase it out. So, at which stage of the product life cycle is the bank's product currently positioned? So, initially, when the product was launched in the beginning, it saw quite a good sales, but now another product has been launched by a competitor, which is a better one. Higher returns, lower risk, so a slowdown in acquisitions and customer retention is there. So, whether we are in the growth stage, maturity stage, saturation stage, or the decline stage. So, this is what? This is the characteristic of the decline stage, right? Where what happens? A more attractive alternative with higher returns is there, and the customer retention is lowering. But it has not yet, I will explain, wait a minute. We will explain all the options. What is happening here? A competitor has introduced a better product. Our acquisitions and customer retention is going, there's a slowdown, but yet negative sales are not here. The management is debating whether to revamp the product, enhance the benefits, or phase it out. So the particular management, they're trying to understand what we can do to keep the product still in the maturity stage. All right, in the maturity stage, which is the third stage. Yes, profits are there in the third stage. Saturation stage is not a type. We have growth, maturity, decline, and introduction. Okay, so a new product has been introduced, but still it has not declined. Our profits are not declining. We are seeing a slowdown but not declining. If our product sees decline and the profits go down, then it will enter the decline stage. All right. B. Those who have answered B, your answer is correct. Maturity stage. Clear? All right. I will explain it one more time. So what is happening in this scenario? When the product was launched, it saw good profits, right? So here our profits were high. Then other competitors, when they enter the market and create a better product, so our product will be seeing maturity, that is maximization. Beyond this, the profits will not increase if we do not give better benefits or we do not try to revamp the product. We cannot get more profits than that. And if we do not try to do it, then we will enter the decline stage where our profits will reduce. But right now, the management is still deciding how can we keep the product in the maturity stage. So it will be in the maturity stage. Slow down. Listen, try to understand. When we are okay, let us come back to this. Yes. What happens when we are talking about the maturity stage? There is inflow of business and profit. Okay. What happens in the decline stage? Because of competition and better products available, staleness will creep in and it will result in the saturation. So now the customers will become indifferent. This will now later lead us to the decline stage. After all of this will happen, then we will enter in the decline stage. All right. So in the decline stage, the product will become less attractive and the sales will drop, profits will also drop. And if we do not attend it properly, then it will lead to product death. So we are trying to fine tune it, trying to add value to it so that it still has continued acceptance. So it is in the maturity stage, still in the maturity stage. Decline has not yet started, right? Okay, all right. Next, how do core and augmented products differ in the terms of marketing? Core products require extensive marketing orientation. Augmented products need significant marketing efforts to succeed. Core products cater only to specific segments. Augmented products cater to all the customer segments. So when we are talking about the different types of products, we have the core product, expected product, augmented product, potential product is also there. So how do core and augmented products differ? Do core products require extensive marketing orientation? No, because these are the basic and general product which already have a market base. Augmented products, they need specific marketing. Core products, they only cater to specific segments. No, they cater to the mass segment. All of the customers, they are availing the core generic products. And augmented products, they cater to all segments. No, these cater to the specific segments. So these are what? These are the add-on. We cannot force the customers to purchase a insurance product along with my core product, right? What is the augmented product? It is add-on product or value added. Something that I give as a complementary product with my core product to increase its value. So the correct answer will be B. All right, so generic product is unbranded, undifferentiated, like rice, wheat. It is a core product, like savings bank account, current deposit. All right, it is the same product is given to all the customers. Then expected product is something that the customer expects they are going to get with the core product, minimum. So along with my savings deposit, I will get a debit card, ATM card, passbook, checkbook. I expect to get this product. Augmented is a add-on feature, something which adds value. So value added, and potential product is a futuristic product. So card less withdrawal at the ATM. AI enabled ATM. These are potential or futuristic product that will have demand in the future. All right. Yes, so we are given the definition of the generic and expected product here, augmented and potential product here. Augmented product for enriching the product voluntarily, result of voluntary improvements. Potential product which is done to attract and hold the customers for the future. So new ideas, redesigning, it is a tomorrow's product. So core, general, basic, expected minimum product, augmented, value added, potential, futuristic. This is how we are going to remember the types. Okay. What are the key features of the basic savings bank deposit account as per RBI guidelines, the BSBDA? Requirement of maintaining a minimum balance, unlimited withdrawals per month, provision of deposit and withdrawal of cash at the bank branches and ATMs, facility of an ATM card or ATM cum deposit card without any charges. What are the features of the BSBDA account? B, yes. Very basic question, right? Very basic. Provision of deposit and withdrawal at the bank branches and ATMs is there, right? And facility of ATM card is also there without any charges. They do not have unlimited withdrawals or maintaining minimum balance is not required. No frills. Okay. If a customer opens a BSBDA account based on simplified KYC norms, how is the account treated? As a regular savings account with all standard features, it will be subject to the same conditions as other BSBD accounts. As a small account subject to specific conditions, the account will have restricted access to electronic payment channels. As a small account, yes, what are the characteristics of a small account? Let us also see. So these are the characteristics of BSBDA account. It is a normal banking services, no minimum balance. The services available will include deposit and withdrawal at the branch as well as ATM, receipt or credit of money, then deposit or collection of checks. There will be no limit on the number of deposits that can be made in a month. However, withdrawals will have a limit. Maximum of 4 withdrawals in a month. ATM cum debit card is also there. So it is provided without any charges. Other things, KYC, AML guidelines will be followed. What else? What else? If a customer has any other savings bank deposit account, then she or he will be required to close it within 30 days from the date of opening a BSBD account. All right. If such an account is opened on the basis of simplified KYC norms, the account would additionally be treated as a small account. There will be certain conditions that will be stipulated. All right. So it will be treated as a small account. Then how is an unclaimed term deposit treated after its maturity? It is automatically renewed for the same period. The interest rate is increased as a penalty. The deposit is considered void and forfeited by the bank. It attracts an interest rate applicable to the savings deposit. So, if you remember, we had done this yesterday. Yes, great. We had discussed this yesterday. Term deposit for a fixed period, it is available, withdrawable after the expiry. Okay, we are given the definition of term deposit and overdue deposit. Overdue means the term deposit which are not withdrawn on maturity, and the notice money which is not withdrawn on the expiry on the notice given. So it is now a demand deposit. It attracts the interest rate applicable to the savings deposit. All right. What are the periodic updation intervals for KYC in banking based on the customer risk categorization? Every 2 years for the high risk customers, every 5 years for the medium risk customers, every 8 years for the medium risk customers, or every 10 years for the low risk customers. Hmm. B. Correct. Very basic question, right? So this is under the prevention provisions of the PMLA Act. Banks are required to follow certain customer identification procedure like KYC, customer acceptance policy, identification procedures, and so on. So for the low risk customers, every 10 years we need to update the KYC. For the medium risk, every 8 years, and for the high risk, every 2 years. Statement second is incorrect. All right. What differentiates bill finance from demand loan and term loan in traditional credit schemes? Bill finance is self liquidating. Demand loan and term loan do not require collateral. Demand loan and term loan have indefinite repayment periods. Bill finance does not have a definite repayment period. How is it different? How is the bill finance facility different from the demand or term loan? What is the feature of the demand loan and term loan? That they have a definite repayment period, right? But a bill finance is self liquidating. A bill finance is self liquidating. All right. So, with the realization of bills purchased or discounted for the borrower, it will be liquidated. But a demand and term loan will have a definite repayment period within which the repayment will be done using the EMIs. All right. For a bank to engage in para banking activities through a subsidiary company, what is a necessary regulatory requirement? Para banking are third party products, compliance with the international banking standards, joint venture agreement with a foreign bank, prior approval from the RBI, a minimum set capital reserves as per the Basel III norms. When the bank has to establish a subsidiary company, it means they are participating with risk taking. So, for that, yes, for that they will require prior approval from RBI. If they are conducting the para banking activities departmentally, then they do not require prior approval of RBI. But through subsidiary, then this approval is required. All right. Which statements accurately describe the augmented product stage in banking? It involves adding voluntary improvements to enhance the product value. It focuses solely on the basic functions. It includes additional features which may not be explicitly requested by the customers. It represents the most advanced stage of product development. So, which of these statements are correct about the augmented product? D, D, D. Yes. The most advanced stage of product development is the potential or future product. Potential or future product. Basic functions of banking products is the core or generic product, right? We have just covered a question based on this topic only. All right. What constitutes the basis for assessing a person's credit score? The individual's income level and savings, Past credit dealings like home loans, auto loans, credit card usage, the person's educational background and employment history, dealings in the credit products such as personal loans and overdrafts. This also we have covered. So, what will be taken into account when we are assessing the person's credit score? Two and four. D. D. Past credit dealings and dealing in credit products such as personal loans. So the correct answer is D. Not C. The correct answer will be D. Yes. So it is the statistical analysis of a person's past credit dealings which refer to their credit discipline, right? It is assessed based on the dealings in the credit products. It can be generated by the CICs and even by self. RBI has made it mandatory for all the CICs in the country to give a free full credit report without any charge once a calendar year. Credit score is a three-digit score from 300 to 900. Above 700 is considered very good. All right. So these are the features. How does a higher score in credit scoring model? What does a higher score in the credit scoring model indicate? A higher probability of default, a lower probability of default, increased wealth of the managed individual, better financial management skills. Yes, it will be. Why is the answer wrong? It will be B. Okay? A lower probability of default. Whether a score is good or not will depend upon the bank's own internal policy. Some banks they perceive 700 and more as a good score. Then credit score will help the banks reduce default. They will also improve the operational efficiency. Anyways, if a customer has a better credit score above 700, it means that they have less defaults in their past dealings. They have a good portfolio of loans. They are not just taking unsecured credit cards, but secured loans are also there, like home loans, car loans are also there, right? And if there are any aberrations, any default, it is because of a genuine reason. So a higher credit score will show a lower probability of default. All right. Scenario. Amit is a young professional who applies for a home loan. Despite earning a stable income, his loan application is rejected due to a low credit score. On reviewing his credit report, Amit finds that he has multiple recent loan inquiries and several short term credit accounts. Additionally, he had delayed a few credit card payments in the past year. Concerned, Amit consults a financial advisor who explains that frequent borrowing and late payments negatively impact the credit scores. The advisor suggests maintaining financial discipline and avoiding excessive credit applications. Which of the following best explains why Amit's credit score is low? Limited credit history, frequent loan inquiries, strong credit mix, high savings balance. Very simple, right? Seems to be lengthy, but it is very simple. The correct answer is B. Frequent loan inquiries. All right. Next, what is the consequence of not maintaining the minimum balance required in a current deposit account? The account will be closed immediately. No interest will be paid on the account balance. A penalty is charged, or the overdraft facility will be automatically activated. So, if we do not maintain the minimum balance in a current deposit account, what will be the consequence? Correct. C. A penalty will be charged, right? So it is a non-interest bearing bank account, needs a higher minimum balance. Penalty is charged if the balance is not maintained. It charges interest rate on the short-term funds or overdraft. Continuing nature does not promote saving habit. All right. Basically, to enable the businessmen to conduct their business transactions smoothly. There's no restriction on the number and amount of deposits, the value of the withdrawals made or the deposits made, and no interest is received. Yes, minimum balance charges. All right. What documents are primarily required for a sole proprietary firm to open an account? Registration certificate, PAN card of the sole proprietor, utility bills for the firm's address, income tax return in the name of the firm. Now, although it might seem that all the documents are required, but the question is asking primarily required. The most important documents that are required that you need to answer. Yes, so the correct answer is A, 1 and 2, not D, 1 and 2. Registration certificate and the PAN card. These are the main important documents that are required. Other things are complementary. All right. So 1 and 2 only. 1 and 2 only. The registration certificate of the sole proprietorship and the PAN card. All right. So here the documents are given. For the sole proprietorship, what do we require? A certified copy of an OVD as mentioned, and then a certified copy of any of the two: registration certificate, certificate or license, sales and income tax return, CST, VAT, all of these things. Okay. Then similarly, documents required for the partnership firm, HUF and LLP is also given. Go through these tables. But why for sole proprietor? We are talking about the current account, not a savings account, but a current account. All right. So I've given the table. You can just go through the documents. All right. So current accounts can also be opened for all scheduled banks, apex cooperative banks, government bodies, district cooperative, land mortgage, urban cooperative. All of these can also open a current account. All right. This was the point that we covered yesterday. If we want to open an account for any individual who has already taken a or who is availing credit facilities, so RBI has given certain guidelines for that, right? If we want to open the account for an individual who already avails credit facilities, then that bank who has more than 10% of the exposure, only those can open the current account, right? Other banks can open only the collection accounts subject to the condition that funds deposited will be remitted within 2 working days to the cash credit or overdraft account. Then there was the exposure. If it is less than 5 crore, then there is no restriction. Any bank can open the current account for the customer. Just they will, if the exposure exceeds 5 crores, then they will have to inform the bank. Beyond that, if the credit exposure is more than 5 crore, then only those banks that have at least 10% of the exposure, they will be allowed to open the account. All right. We will have question. I'm sure the question would be there related to this topic also. Okay. What documents are required for the charitable or public trust? Again, If you think that you can remember the documents, fine. If not, don't worry. Even if this question comes, it will be difficult for all of us, not just for one single person. All right, so some questions are which you can skip or simply you can guess. Don't skip any question, mark any answer if you don't know the correct answer. Okay, so document required for charitable or public trust, power of attorney, trust deed, OVD of all the trustees, list of the members of the managing committee. So although I don't remember all the documents which are required, but why would the bank ask me for the list of the members? The bank won't ask me the list of the members. So I will cancel out B and D. Power of attorney again. If the trust gives power of attorney, then it is a situation, otherwise not. So the trust deed and the OVD of all the trustees. This will be required. I can make a calculated guess. Yes. C will be correct. All right. C is correct. So this is the question that I was talking about. According to the RBI notification, what is the restriction on opening current account for the borrowers that have exposure less than 5 crore? Very important. All right. No restriction on opening current account. Must maintain a minimum balance of 5 crore. Must obtain permission from RBI. Must inform the banks when credit facilities reach 5 crore or more. Only one person listened to me carefully. The restriction is there that you must inform the bank when the credit facilities reach 5 crore or more. D is correct, Hema. Yes. D is the answer. This is the restriction on opening the current account. All right. There is a restriction. Whichever bank that opens the current account for such a customer, the customer will have to inform the bank when the credit facilities reach 5 crore. All right. So for the borrowers, when the exposure of the banking system is less than 5 crore, there is no restriction on opening the current account on the provision of CC or OD facility. But they will obtain an undertaking from the borrowers that they shall inform the bank as and when the credit facilities availed by them reaches 5 crore or more. And if the in respect of borrowers where the exposure is 5 crore or more, then such borrower can maintain the current account with only the bank with which they have facilitated the CC or OD facility. Okay, so if let's say this is a multiple selection type question, options are given to you A and B, B and C, A and D, C and D. Then you will mark both A and D, both A and D. If this restriction is not given to you, then answer will be your option A. No restriction on opening current account. All right. But if this is an option and only four options are there, then you will have to select this one. All right. If you are given must inform the bank when credit facilities reach 5 crore or more, then this will be the correct answer. All right, clear? Okay. So remember these 2 points. Less than 5 crore, any bank can open, subject to the condition underwriting should be taken. More than 5 crore, only that bank which has at least 10% of the exposure will open the account. If let's say no bank has minimum 10%, then the bank that has the highest exposure can open the account for the customer. All right. In opening a current account for individuals, what precautionary measures should be taken in the operational instructions section of the account opening form? So, there are certain situations in which the current account can also be opened for a individual. So, what should be the instruction? The section should be filled with the account holder's details. The section should be left blank. The section should be crossed out. The section should contain the bank manager's signature. Operational instructions. If an individual is opening the current account, then do we require any operational instruction or not? Right? If we are opening the account for an individual, then yes, the column meant for operational instructions in the account opening form should be crossed out. It should be crossed out. Why? To prevent its subsequent misuse while opening the current account in the name of individuals. We will simply cross it out. Okay. If we are opening a joint account, then the operational instructions can be either or survivor, anyone or survivor, former survivor, anything. But if we are opening for the individual, then it will be crossed out. All right. The section should be crossed out, huh, to prevent any further misuse so that not more than one person they start using the account. All right. How are inoperative current accounts defined and treated by the banks? Accounts with no operations for 2 years, with incidental charges applied every half year. Accounts with no operation for 1 year, with annual charges applied. Accounts with operations but without significant balance. Accounts that have been flagged for suspicious activities. Inoperative account, yes, inoperative account is when there are no operations for 2 years. Continuously for 2 years, it will be treated as an inoperative account. Bank will recover the incidental charges every half year to the debit of the inoperative account, and they will credit it to the incidental charges. After, if the customer wants and they approach the bank to get the account operative, it will be done after the bank is satisfied with the reasons for non-operation, and fresh KYC should be duly obtained and verified. All right. What actions should a bank take regarding the dues and liabilities of a customer before closing their accounts? So, if a customer wants to close their account, what will the bank do? Write off any outstanding dues, transfer the dues to another account of the customer, recover all the dues relating to outstanding liabilities before releasing the balance, inform the customer about the dues but proceed with account closure. So, what will the bank do now? Firstly, the bank will try to know what is the reason for the closure of the account. They will try to persuade the customer, the holder, to continue it. If, however, yes, if, however, if customer wishes to close the account due to some genuine difficulties, then any check pending, under collection, any other pending transaction, guarantee, letter of credit issued, this will be checked. The charges will be recovered as per the bank's guidelines, charges for premature closure. The bank will also recover all the dues which the customer may owe to the bank in respect of any outstanding liability, like credit cards, guarantees, indemnities, etc. All right. So this will be done. Okay. What are the requirements for a minor to open and operate a savings bank account? Minor is allowed, but what are the requirements? The minor must be at least 10 years old and able to read and write. The account should be jointly operated with a guardian. The minor can operate the account without any supervision if below 10 years. The checkbook facility is automatically provided to all the minor accounts. We have covered this in detail in our capsule batches as well as in the MCQs in the first marathon session. So, yes, the correct answer is A, right? So, the minor should be able to read and write any of the languages which are recognized and capable in the opinion of the branch manager, that they understand what she or he is doing, they understand the rules and regulations. This will be signed by the minor in the presence of an official of the bank. Date of birth will be ascertained. On attaining the majority, necessary steps should be taken, that fresh instructions regarding operation should be done. All right. What is required in terms of the PAN or GIR for accounts of minors if the minor income is not chargeable to income tax? So, PAN or GIR of the minor is mandatory. The PAN or GIR number of the father or mother or guardian, declaration form of number 60 or 61 from the minor is always required. No information regarding the PAN or GIR is required for the minor accounts. So if the minor's income is not chargeable to the income tax, what do we require? We require the PAN or the GIR is the General Index Registration Number. GIR, General Index Registration Number. All right, given by an assessing officer to the assessee, the taxpayer. So it will contain the details of the assessing officer as well. So what is required in the case of a minor? The answer is B. The PAN or the GIR number of the father, mother or guardian. All right. So these are the other features for the account of the minor, right? Everyone, no, not C. The correct answer is B. Yes, B will be correct. If their income is not chargeable to income tax, then the father, mother, or guardian's details will be required. So B is correct. All right. In case they do not have the PAN or GIR number, then a declaration form number 60 or 61 will be accepted, but it is not always required. All right. Okay. Which type of account operation facility is not provided to an illiterate person? Checkbook facility, ATM card usage, joint account with a literate close relative, both A and B. Which facility is not provided? To an illiterate person, ATM card usage is not provided. If you are answering A and B, C, joint account, no, joint account can be opened with a literate close relative. What is not allowed? Checkbook facility is not allowed. Checkbook facility is not provided to an illiterate person. All right, no checkbook facility. Joint account can be opened with a literate close relative, father, son, husband, wife, mother, and daughter, but not two cousins, right? If they're coming for withdrawal, they will have to come personally, affix her or his thumb impression in the presence of an officer. They will lodge their recent photograph with the bank. Signature card should be there. All right. So only checkbook facility will not be given. ATM card, joint account, that is all of it is allowed. All right. Okay. Next, what additional steps are taken for the accounts of blind persons? Blind persons. No extra steps. They are treated the same as other customers. Their account opening form and passbook are stamped with the blind person. Then blind individuals are not allowed to withdraw cash without assistance. Only joint account with a sighted person are permitted. So we are talking about additional steps. Why additional steps are taken? So that no dispute arises, that the blind person was not explained about the account, the rules and regulations. So their account opening form and passbook are stamped with blind person. This is the additional step taken. All right. Hmm. So both the signature and thumb impression will be taken even if the individual. How? Okay, it depends from bank to bank. All right, it will vary from bank to bank. All right, ATM card is not issued. But as per RBI's guidelines, the bank they cannot reject the facility. Only checkbook facility is not given in the case of illiterate individual. Okay. Hmm. Next, what are the terms and conditions for opening a joint account with two or more illiterate persons? Illiterate persons. Joint account holders must be close relatives and operate the account jointly or by survivors. Checkbook facilities provided. So, which of the statements are correct? Both 1 and 2, neither 1 and nor 2, only 1, only 2 in case of illiterate persons. In case of illiterate persons. Yes, only 1, right? So, with close relatives, they can open account. If they're opening it, it will be a joint account, right? And to make any withdrawal, both of them should come to the bank personally. These are the instructions. But here also, checkbook facility will not be given. Then, what special measures are taken for the bank accounts of persons who cannot sign due to loss of both hands? Only digital signatures are accepted. A mark including a toe impression is accepted. A legal guardian must always operate the account. Both B and C. Hmm. So if the individual is unable to give their thumb impression, then toe impression may also be accepted. All right. So the bank branch should obtain the photograph. The handicapped person may be requested to put her or his toe impression. This will be done before the branch manager, joint manager, department, and a witness. They can also give a suitable power of attorney to any other person. And this power of attorney will sign the forms. Alright, so B will be correct. Not D, a legal guardian must always operate. No. Alright, a legal guardian exists in the case of the minor, right? So here this will not be true. Okay? And if they had given the option of power of attorney, that is also not a mandatory requirement. If the individual wants, then they can assign a power of attorney, otherwise not. All right, so these are the special measures. A mark including a toe impression is also accepted. Okay. Which non-individual entities are allowed to open a savings account as per RBI guidelines? Government departments relying on budgetary allocations, primary cooperative credit societies financed by the bank, municipal corporations, self-help groups registered or unregistered. So, which non-individual entities are allowed to open a savings bank account? Non-individual entities. So, government departments relying on budgetary allocations? No. Primary cooperative credit societies are allowed. Municipal corporation will again come under the government department, and self-help groups are again allowed. So the correct answer will be D, 2 and 4. 2 and 4. All right, D, no, not B, D. Yes. So the following categories of non-individual entities are allowed to open a savings bank account. Primary Cooperative Credit Society, KVIB, the Khadi and Village Industries Board, APMCs, societies registered under the Societies Act, companies which have been licensed by the central government. All right, government departments are allowed, but when they're not relying on budgetary allocation. Then self-help groups, farmers clubs, these are also allowed. All right. What are the conditions imposed by RBI on banks for setting interest rates on savings bank deposit? So the interest rates have been deregulated, right? But still there are certain conditions. Banks can offer variable interest rates for deposit below rupees 1 lakh. A uniform interest rate must be offered on deposits up to rupees 1 lakh. Banks are required to offer higher interest rate for deposits over rupees 1 lakh, and differential interest rate can be offered for deposits over 1 lakh. So what are the RBI conditions? B, 2 and 4. Hmm. Yes, B is correct. So each bank will have to offer uniform interest rate. On uniform means RBI has not fixed it. It has said that all the customers who have a deposit of less than 1 lakh rupees will receive the same interest rate. Doesn't matter if the deposit is 20,000 or it is 50,000 or it is 90,000. Below 1 lakh, uniform. Above 1 lakh, differential rate of interest can be offered on the condition that the bank will not discriminate in the matter of interest paid on such deposits between one deposit and another of similar amount accepted on the same day, right? So if two deposits are accepted by the bank on the same day, both of the deposits are worth rupees, let's say 2 lakhs, then they will have the same rate offered on different date, offered on different deposit value, then differential rate of interest can be offered. All right, so the correct answer is B, 2 and 4. How do banks typically calculate the interest on savings bank deposit now? Annually based on the minimum balance maintained, monthly on the average balance, quarterly on the daily product basis, biannually on the maximum balance. How do the banks calculate their interest on the savings bank deposit? Yes, so banks are paying different interest rate on the savings deposit. And how do they offer it? They offer it quarterly on the daily product basis. Quarterly on the daily product basis. Daily, whatever deposits they are getting, on that basis, they will calculate. All right. Can banks accept fixed deposit for periods that are not in multiples of complete months? When we are talking about the minimum and the maximum duration of a term deposit. Minimum period is what? 7 days. Maximum is what? 120 days. Then in between, let's say the deposit is offered for a period of 12 months. Then in multiples of 3, 15, 18, 21. But at specific request of the customer, branches may accept deposit for any period in multiples of complete month or even when the terminal month is incomplete. So yes, at the specific request of the customer. At the specific request of the customer. So 7 days for the deposit amount of 15 lakhs and above. 15 days when the deposit is less than 15 lakhs. Maximum period is 120 days. When the deposit is more than 12 months, we should try to keep it in multiples of 3, but other multiples are also allowed. Yes, so D is correct. So if the customer specifically requires, then this will be there. Otherwise, the period will be tried to be kept in multiples of complete months only. Okay. What is the impact of the penalty on the interest rate in case of premature withdrawal of FD? The penalty has no impact on the interest rate. The interest rate remains the same as agreed upon at the time of FD creation. The interest rate is reduced by the penalty amount. The penalty is charged separately and does not affect the interest rate. So, in the case of a premature withdrawal of FD, normally banks they refuse to make the premature withdrawal, but for genuine reason, if they agree, the interest is paid at the rate applicable to the period for which the deposit has remitted, less the penalty. So whatever the interest rate is there on the FD, we will subtract the penalty from it. So the interest rate is reduced by the penalty amount. All right, it will be reduced by the penalty amount. Penalty varies from bank to bank. If let's say 1% is the penalty, then and the interest rate is 8% per annum, then the applicable rate of interest will be what? We will reduce that 1% from it. All right. So now it will be 7%. Okay. All right. What is the TDS rate on the interest rate from the time deposits if the depositor has furnished their PAN card? 10% if the PAN card is furnished, 20% irrespective of the submission. So, just this. What is the TDS rate on the interest from the time deposit? This is the question. Second part is not here. Consider that the second part is not here. So 10% if the PAN card is furnished, 20% irrespective of the submission of the PAN card, 5% for all the depositors, 20% if the PAN card is not submitted. So deduction of income tax at source from the payment of interest on time deposits. So let's say the TDS when is it is to be deducted when the total interest paid or credited on all time deposits in the name of the depositor. Not one deposit only, but all the names of the depositor exceeds 50,000 rupees. Right? Then the TDS will be 10% if the depositor has furnished the PAN card or 20% if they have not furnished the PAN card. So B, 1 and 4. All right. So the limit is 50,000 in the case of senior citizen and 40,000 in case of depositors of age below 60 years. All right. Okay. What is the usual range for the percentage of loan banks offer against the value of a fixed deposit? 100 to 110% of the value, 50 to 60%, 80 to 90%, 30 to 40%. So advances against bank's own time deposit. What is offered by the bank? Right. The bank offers 80 to 90% of the value of the FD. If we are talking about the margin, it varies from bank to bank. If we are talking about the interest rate, then the interest on the loan amount will be higher than what is being paid on the FD. All right, 1 to 2% higher than what is being paid on the FD. All right, margin is retained, and if the customer fails to repay the loan along with the interest until the maturity, then what will happen? The fixed deposit is adjusted against the loan, and if there is any balance left, then it will be paid to the customer. So what will happen if the customer defaults on the payment on such a loan? We can adjust the deposit which has been made, the time deposit. If the bank will issue a separate receipt for each FD because each deposit is treated as a distinct contract. Okay. Under what conditions do banks generally not provide advances on the fixed deposit? Okay. You want a break? Shall we take a 15-minute break? We still have around many questions are left. Everyone, please reply if you want a break or we can continue. You want a break. All right. So, okay, let us take a half-hour break. Let us take a 15 minutes break. Otherwise, our class will get extended for quite long. Let us take a break. We'll take a 15 minutes break, okay? All right. So, 15 minutes break. Hmm. All right. I will see you after 15 minutes. Yes. So, we are back. Am I audible and the video is fine? Everyone? Yes, Hema just started. Yes, yes. We'll continue now. Please confirm the audio and video is fine. It is working okay. All right. Clear. All right. So let us start then. Hmm. So we were here. Under what conditions do banks generally not provide any advances against, okay, I have the answer, against the FDs that are less than a year old, against third party deposit receipts, except under special circumstances, against FDs with high interest rates, against recurring deposits unless they have been in existence for at least 1 year. So, in which of the following cases the banks generally do not provide advances? Do not provide advances. Yes, B, correct. Right? So, against third party deposit receipts and recurring deposits that have been in existence for less than 1 year. Rest all the situations the banks they accept to give deposits. All right. So banks they do not encourage advances against third party deposits, but wherever granted, higher interest rate will be charged. Then the banks in special cases only to valuable clients they will advance against the fixed or short deposit receipts. Recurring deposits solely in the names of minors again not granted. All right. So these are the correct statements. Okay. What is the significance on RBI's rule on overdue FDs? It mandates automatic renewal on all overdue FDs. It guarantees the same interest rate post maturity for unclaimed FDs. It ensures unclaimed FDs post maturity earns some interest. It requires banks to contact customers for the FD renewal. So when the FD has remained overdue, that is after the maturity, the account holder has not claimed it. So what will happen in this situation? We have covered a similar question. The banks they continue to offer interest, but the interest that will be offered will be the same as on the savings bank deposit. So some interest will be there, but this will not be on the fixed deposit, but on the savings deposit. All right. So, according to the new rules, if the fixed deposit is matured but the proceeds are not renewed, they remain unpaid and unclaimed, then the amount which is not claimed will attract the rate of interest as applicable to the savings account or the contracted rate, depending on which one is lower. All right. So it will be reduced to the savings deposit rate. Okay. When should Form 15G or Form 15H be submitted to the bank? At the time of opening the fixed deposit account only, once in a lifetime for each customer, every 5 years, annually, generally at the beginning of the financial year. So, Form 15G and 15H. What is it related to? If I fall under the exempted limit of TDS and I want to instruct my bank to not deduct the TDS, then Form 15H is for the senior citizens, Form 15G for less than 60 years of age. And yes, it has to be submitted for every financial year, generally at the beginning of the year. All right, so we have already seen the limit 50,000 for senior citizens and 40,000 for the below 60 years of age. Quickly, we will try to answer these questions quickly. That was the interest on the term deposit. Now, about what are the current income exemption limits for the different age groups for submitting these forms? 2.5 lakhs for the individuals below 60 years, 3 lakhs for senior citizens, 5 lakhs for super senior citizen, 5 lakh for individuals irrespective of their age, no exemption limit. All individuals have to pay tax on interest income. 1 lakh for individuals below 60 years, 2 lakh for senior citizens, and 5 lakh for super senior citizen. Correct answer, yes. The correct answer will be A. Those who are less than 60 years, income up to 2.5 lakh is exempted. Senior citizens up to 3 lakhs, super senior citizens 5 lakhs. So there will be no tax liability here. All right. If you don't understand any term, please ask me, but we are trying to go a bit fast. All right. What is the method used for breaking FDs in the reverse sweep facility? First in, first out, random selection, last in, first out, based on the interest rate. LIFO, last in, first out. Yes, correct. Last in, first out. So this is what? This is a two-in-one scheme. Features of both savings account and current account are here. We get the liquidity of the savings account and high interest of the fixed deposit, not not of the current, but the fixed deposit. So there are auto sweep and reverse sweep. Auto sweep means from my savings account, and we have the reverse sweep. Reverse sweep facility. I think we have a question regarding that also. Or not? Just a second. Right. So, auto sweep facility balance which is in excess in my savings deposit. So, from the savings deposit to the fixed deposit, this is auto sweep. So, now I will get higher rate of interest. Reverse sweep is from my fixed deposit to my savings deposit. Opposite is happening. When I have insufficient funds to make the regular payments. All right. So, it will be sent to my savings deposit. So last in, first out means the deposit which is broken, the last deposit is broken to meet the shortfall in the savings deposit. This is the meaning of last in, first out. Okay? All right. Who can open a recurring deposit account? Any person duly introduced to the bank and fulfilling the KYC norms, minors of 10 years and above, subject to the bank's terms, only salaried individuals, only senior citizens who can open a recurring deposit account. What is a recurring deposit account? Customers who have a regular income, they can save a fixed amount every month. I do not have a lump sum to create a fixed deposit, but every month I can instruct my bank to deduct a certain amount from my deposit and create a RD, right? It is also for a fixed period, similar to the fixed deposit, right? So the correct answer will be A. N- You are saying D. Only senior citizens? No. Only senior citizens is not a criteria. All right. So the recurring deposit can be opened by a person in their own name. It can be also opened by one person or more than one person in the joint name. So any person introduced to the bank and fulfilling the KYC norms. Even a minor of age 10 years and above can open a account. All right. So the correct answer will be A. Okay. Is tax deducted at source applicable to the recurring deposit account? No, TDS is not applicable. Yes, similar to FDs. TDS is applicable only if the interest exceeds 10,000 rupees. TDS is applicable at a higher rate than FDs. So is TDS applicable or not? Yes. So TDS is applicable in case of RD accounts similar to the FD. All the conditions will be same. All right, it will be similar. Okay. So this is the correct answer. The correct answer is B. Similar to FDs. All right. Banks also provide loans on RD on the same terms and conditions. Premature payment of RD is also allowed again on the same terms and conditions as are there in the fixed deposit. Okay. How do banks handle access to a jointly hired locker with a survivorship clause upon the death of one of the locker hirers? Access is given to the legal heirs of the deceased hirer. The locker remains inaccessible until all the joint hirers pass away. Access is provided to the survivors as per the survivorship clause. The locker is sealed until a consensus is reached among the surviving hirers. So, what will happen in this situation? Right, so access will be provided to the survivors as per the survivors mandate. The bank will not wait till all the hirers they pass away. Okay, so it will be given to the survivors. All right. What is the minimum take home, net take home pay or income required for the home loan applications? That is, after making deductions for the EMIs, all the other charges, what income should be left with the customer that they take back home? At least 50% of the gross income, no minimum requirement, varies from bank to bank, generally not less than 40% of the gross income. High income applicants, even up to 15% is considered. Yes. So both C and D. Normally 40% if the gross income is higher than 15% is also there. Both C and D. All right. So you can go through these points on your own. If you do not understand anything, then you can ask. All right. Which of the following statements regarding the beneficiary eligibility under the CLSS scheme is not correct? Not correct. A married couple can only apply for separate houses if both individuals meet the income criteria independently. An adult earning member of the family, irrespective of the marital status, can be considered as a separate household if they do not own a pakka house. The scheme excludes family owning any all-weather dwelling units across India. Joint ownership of a single house by a married couple is permissible under the scheme provided they meet the income eligibility criteria. Credit linked subsidy scheme under the Housing for All. Which of the following statements is not true? Not true. C scheme. Why the scheme does include exclude the family members? If any of the family members they own a all-weather dwelling unit anywhere in India, they will be excluded. So C is correct, right? You need to answer which one is not correct. Not correct. Joint ownership of a single house is allowed, and uh, if the adult is a earning member of the family, they will also be considered as a separate household. Yes, the correct answer is A. A married couple cannot apply for the separate house even if the individuals they meet the income criteria independently. All right. The correct answer is D. D. What is the eligibility? A beneficiary family will comprise of the husband, wife, unmarried sons, and or the unmarried daughters. The beneficiary family should not own a pakka house, either in their own name or any of the member of the family in any part of India. All right? An adult earning member will be treated as a separate household if they do not own a pakka house anywhere in India, right? And In case of a married couple, either of the spouses or both together in joint ownership will be eligible for a single house, not separate. Okay, not separate. They cannot apply for a separate house, only for a single house they will be eligible. A married couple will be eligible for a single house. Okay, so the correct answer is A. Yes. All right. Which of the following statements are correct regarding the income criteria under the scheme? Households with an income of up to 3 lakh qualifies under the EWS. LIG category applies to households earning between 3 lakhs to 6 lakhs. MIG 1 applies to households earning 6 lakhs to 12 lakhs. MIG 2 applies to households earning 12 lakhs to 20 lakhs. So what is the income criteria? I told you can remember the way how to remember the income criteria. So what will be the correct answer? Which of the following statements are correct? D, D, D. Okay. The MIG2 applies to the households earning income between 12 lakh to 18 lakh. Not 20 lakh, but 12 lakh to 18. For the EWS, it is 3. LIG, it is 3 to 6. MIG1, 6 to 12. And MIG2, 12 to 18 lakhs. So the correct answer will be A. 1, 2, and 3. Fourth statement is not correct. Alright? The correct answer will be A. Hmm. A is there. Okay? I have given you the table. You can go through it. The beneficiary, income criteria, interest subsidy, maximum loan tenure, maximum loan amount eligible for subsidy, and the maximum carpet area. Alright. Next. Rohan has secured admission into a university with an annual fee of 80 lakhs. No, 8 lakhs. Okay. He receives a scholarship of 2 lakhs and a fee waiver of 50,000 per year. His lodging and boarding expenses outside the campus amount to 1 lakh 20,000 per year. What will be the total loan amount that Rohan is eligible for per year? What is the total loan amount? So we are talking about the education loan. What all is included in the education loan? The eligible expenses, fee payable is included, travel expenses are included, caution deposit, any other expense, boarding, lodging, all of these are included. What do we deduct from it? Any scholarship and fee waiver is deducted, right? Any scholarship and fee waiver is deducted. So the annual fee is what? It is 8 lakh rupees. From it, we can deduct the scholarship and waiver. So 2 lakh 50,000 will be deducted. We are left with 5, right? From it, we will add 5 lakh 50,000 is left. Then we will add to it the lodging and boarding expenses, that is 1 lakh 20,000 per year. So it will become 6 lakh 70,000. This is the loan amount that Rohan will be eligible for. No, not A. All right, understood how we have calculated? The fee is 8 lakhs. Rohan is also getting scholarship and fee waiver. So we will deduct from the fees. We will add the lodging and boarding expenses. All right. So the correct answer will be B, 6 lakhs 70,000. All right. Next, when processing retail loans through RLPCs, select the correct statements. Retail loan processing centers. So we have the standalone model and the centralized model. RLPCs are responsible for executing the mortgage formalities, especially for the mortgage-backed retail loans. The role of RLPCs is limited to processing and up to the sanction. Post-sanction are taken by the respective branches. In some banks, RLPCs function as separate branches providing end-to-end solution. RLPCs do not play a role in determining the quantum or pricing of the loan. So what will be the correct answer regarding the role of RLPCs? So what happens in the retail loan processing centers in the centralized model? The branches, they just get the applications and they send it to the retail hub or the RLPCs. Then what happens? The post sanctioning or disbursement, monitoring, everything is done by the RLPCs. All right, so the correct answer will be C, 1 and 3. 1 and 3. Okay. This, the role of RLPCs is limited to processing up to the sanction. No, the post sanction formalities, follow up, everything is done by the RLPC in the centralized model. All right, so 1 and 3 will be correct. 2 and 4 are incorrect. The question is asking us the correct statements. Yes, you need to mark the correct statements. Shripada, okay? Clear? So that is why option C will be correct. All right. Difference between the standalone model and the centralized model. There's a difference in quality in the branch level. Centralized model, there will be uniformity. Processing time will also differ in the standalone model. It will be uniform and fixed turnaround time in the centralized. All right, so these are the differences. Okay. Which of the following is a key requirement for the banks in India to undertake the credit card business? A minimum net worth of rupees 100 crore, approval from RBI for domestic credit card business, tie-up arrangement with the international payment services, a subsidiary company set up for credit card operations. Minimum requirement for the banks for credit card business. No. To engage in credit card business in India, the banks must have a minimum net worth of 100 crore. This is the requirement. If they are offering the domestic credit card business, then approval from RBI is not mandatory. Subsidiary company or tie-up arrangement, these are not compulsory. All right. If they want to set up subsidiary companies, then they will have to take RBI's approval and they can undertake the business either through a subsidiary directly or a tie-up arrangement. All right. If they want to set up subsidiaries for the credit card business, then they require prior approval from RBI. All right. banks, if they want to set up a subsidiary, then they will require prior approval. All right. Next, which of the following statements correctly describe the evolution of the credit cards? The first bank card, charge it, allowed international transactions. Diners Club card introduced in 1950 was the first general purpose credit card. Early credit cards in the 1990s were made out of plastic and offered revolving credit. Franklin National Bank's credit card introduced in 1951 was limited to the bank's account holders only. So, the evolution of credit cards. Which statements are correct? C. You are telling me the incorrect statements. The correct statements are 2 and 4. The first bank card was known as Charge It, but it did not allow international transactions. Only in the market or through the banks for particular merchants the Charge It card was allowed. If you remember, right? It did not allow international transactions. Okay, so it was issued so that the customers can make purchases from the local merchants in the neighborhood. So this statement becomes incorrect. Diners Club, introduced in 1950, was the first general purpose credit card. Correct. Charge It was not a general purpose credit card. Diners Club was a general purpose credit card. Okay, then early credit cards were made out of plastic and offered revolving credit. No, revolving credit was not there, and the Franklin National Bank's credit card was limited to the bank's account holders only. All right, so the correct answer is D, 2 and 4. In our marathon session for module B, there also I had introduced this. The Charge It card, its role, Diners Club card's role. Okay, so just go through the notes. Which of the following statements are true regarding the credit card transaction systems? In a closed loop system, transactions are processed by multiple banks. Visa and MasterCard operate under an open loop system. American Express operates under a closed loop system. The open loop system requires no interbank cooperation. So, in 1966, ICA was formed, later known as MasterCard. Bank America brand, later known as Visa. So these bank card associations, they create open loop system. MasterCard, Visa, they operate on the open loop system, which means that there is interbank cooperation and fund transfer as well. In the closed loop system, single firm will capture and process all the transaction data. So directly cardholder, merchants, they will authorize, settle all the transactions. So closed loop system is there in the Diners Club and American Express. This is the closed loop system. Open loop system in the MasterCard and Visa. All right. So the correct answer will become C. Yes, correct answer is C, 2 and 3. Visa and MasterCard operate under the open loop. American Express operates under the closed loop. In the closed loop, no interbank cooperation is there. And in the open loop, transactions are processed by multiple banks. Okay. So remember the concepts of the two systems, open loop and closed loop. In the open loop, there will be many participants apart from the bank and the merchant as well. In the closed loop, there will be only the merchant and the bank. All right. Okay. Raj uses a credit card for the retail purchases totaling 10,000 rupees in a billing cycle. His credit card's terms state that the minimum amount due is determined as the highest amount among the following. We already know how the minimum amount due is calculated. Rupees 250 is there, or the percentage if you remember. So for this cycle, the sum of all installments billed calculates to rupees 320, and Raj is not in default. So what is the minimum amount due that Raj must pay? Minimum amount due that Raj must pay. AC, all right. So what are the conditions for the minimum amount? Either 5% of the outstanding, or sum total of all the installments that have been billed, of the interest, fees, other charges, amount that is over the limit, or 250 rupees if there's a default or if the statement balance is less than 250 rupees. So he's not in default, so 250 rupees will not be paid. Then the total retail purchases are 10,000 rupees in the billing cycle. All right. So how do we calculate? We will calculate 5% of 10,000 rupees, right? 5% of 10,000 rupees. 250 would have been paid if there was a default, or their payment that they made using the card was less than 250 rupees. That is not the case. They have made a purchase of 10,000. So the correct answer will be 500. 5% of 10,000. Right? So 5% of the statement outstanding is 5,000 or 500. Sum total of all the installments billed is 320. The default case does not apply because it is well above 250 rupees. So Raj must pay rupees 500. Okay. Which of the following statements accurately describe the policies regarding the issuance, loading, and interest on the PPI balances? The PPI issuers must have policies approved by the board for issuance and related activities. Interest is payable on the prepaid payment instrument balances. PPIs can be loaded by cash, debit to bank, credit and debit, or and other PPIs as well. Electronic loading of PPIs is not permitted. So what is the correct answer here? B? Hmm, correct. The correct answer will be B, 1 and 3 only. Interest is not payable on the balances, and electronic loading is also allowed. So what are the conditions here? A board approved policy will be there for the issuance of different categories of PPIs. No interest will be payable. Loading or reloading by cash, debit, credit, electronic, all of these are allowed, but it will be in the Indian rupees only, INR. Cash loading will be limited to what? It will be limited to rupees 50,000 per month. All right. They may be issued as cards, wallets, or any other instrument. So 1 and 3. Then if you remember the concept of open closed and semi-closed PPIs. So in the closed system PPIs issued by an entity, it can be used for the purchase of goods and services from that entity only and do not permit cash withdrawal. They cannot be used for third party services, so authorization from RBI is not required. In the open system. In the open system, the maximum outstanding amount will be 1 lakh. All right. Semi-closed system used for the purchase of goods and services at a group of clearly identified merchant locations. They also do not permit cash withdrawal. Open system can be used at any merchant and they are issued only by banks. They also facilitate cash withdrawal. Amount outstanding shall not exceed 1 lakh at any point. All right, so these are the points. Okay. Next, how does NEFT facilitate cross-border transactions and what are its limitations? NEFT facilitates two-way cross-border transfers between India and all countries. It offers Indo-Nepal remittance facility for one-way transfers from India to Nepal only. There is no maximum limit on the amounts of funds that can be transferred. Cash-based remittances are limited to 50,000 per transactions. So what are the correct statements here? D, 2 and 4. Right, 2 and 4. So this is the Indo-Nepal remittance facility, right? One-way cross-border transfer of funds from India to Nepal. There is no limit, maximum or minimum, on the funds that can be transferred. However, cash-based remittances will be 50,000. Okay, all the information is given. What is the charge structure for NEFT transactions as specified by RBI? Inward transaction at the destination bank branches are free of charge for beneficiaries. Outward transactions at originating bank are free for all the transactions. Charges for outward transactions vary based on the transaction amount, or RBI has imposed the uniform charge for all the NEFT transactions. So, what are the correct statements about the charges? B, B, yes, B is correct. And what are the charges? Inward transactions at destination bank are free. Outward transactions applicable to the remitter for transactions up to 10,000 not exceeding 2.50, 10,000 to 1 lakh 5, 1 lakh to 2 lakh not exceeding 15, 2 lakh not exceeding 25. All right, so accordingly 1 is correct and 3 is correct. 1 and 3 is correct. Outward transactions at originating banks will be free, no, and uniform charge is not there. However, RBI has removed all the applicable charges on NEFT initiated online. Now, there were fixed timings and the days on which NEFT worked. Again, from 2019, this has also been removed. NEFT is available 24/7, 365 days. There are 48 half hourly batches every day during which the NEFT transactions complete. Okay. Which of the following statements about NEFT and RTGS mechanisms are correct? Gross settlement means the transactions are completed on a one-to-one basis without bunching. NEFT transactions are settled on a deferred net basis. That is, the transactions are processed in batches. RTGS follows a batch based settlement system Similar to NEFT, in RTGS, the transactions are processed individually in real time. Very basic questions. If you get any question from RTGS, NEFT, IMPS, you can easily answer. Hmm. So, 1, 2, and 4. Correct. A, 1, 2, and 4. All right. Which of the following statements does not accurately describe the role of ECS centers in the ECS credit system? ECS centers debit the sponsor bank's account on the scheduled settlement day. ECS centers credit the accounts of the destination bank for further credit. ECS centers process credit only for domestic transactions. They do not support NRE or NRO accounts. ECS centers require users to register before initiating the credit transactions. So, which of the following is not correct for the role of ECS centers? Not correct. Yes, in ECS, NRE and NRO accounts are allowed. These are allowed. So, statement C will be incorrect. Everyone clear? Why statement C is incorrect? Yes? Hmm. Okay. All right. Next, which of the following statements about the local ECS are correct? So there are three variants of the ECS: local, regional, and national. Local ECS operates at 81 centers across India. Local ECS coverage is restricted to the geographical limits of the clearinghouse, covering one city and surrounding areas. Local ECS allows interstate fund transfers between different clearinghouses. Local ECS is operated either by RBI or designated banks. So you need to tell the correct statements. Statements that are true about the local ECS. B, 1, 2, and 4. Right. Statement 3 is about interstate. So we are talking about the regional ECS, RECS. Correct answer will be B, 1, 2, and 4. 1, 2, and 4. All right. So local ECS operating at 81 centers, operated by RBI or designated banks, restricted to the geographical coverage of the clearinghouse. RECS, 9 centers, branches in state or a group of states. These are operated by RBI. NECS is also operated by RBI. It is the centralized version and operated at Mumbai. So all the core banking enabled branches located anywhere in the country are covered in the NECS. Now the NECS, in its place we have the NACH. Which of the following statements correctly does not describe the NACH? NACH replaced ECS on May 1, 2016, facilitates high volume, repetitive, periodic electronic transactions, operates only in select regions, does not provide nationwide coverage like the national ECS. NACH enables bulk transactions such as subsidies, dividends, salary, pension, and utility bill payment. So, both ECS and NACH they have been developed for facilitating the bulk, repetitive, and periodic payments, right? So, if any institute has to pay salary, interest, dividend, or any institute has to deduct, let's say, pension or EMI, any other subscription fee from many customers. So from the sponsor bank to the destination bank, the user bank, destination bank, this is the process. And NACH, it operates all over India, centralized. So statement C will be incorrect. All right, statement C will be incorrect. Okay. So yes, it is a centralized system consolidating the multiple ECS, harmonization of standard and practices. We also have the mandate management system, dispute redressal system under the NACH, which was not there in the ECS. All right. What is the role of the sponsor bank in a NACH transaction? Sponsor banks handle the international transactions. They forward mandates from corporate customers to the destination banks for approval. Sponsor banks are responsible for the final settlement. They validate customer details in the mandate approval process. So, what is the role of the sponsor bank? If we are talking about the parties to the NACH, we have the sponsor bank, destination bank, users, clearing system, settlement facility. So the role of sponsor bank is yes to they will forward the mandate given by the corporate customer through the NPCI to the destination bank for approval, right? Then destination banks, they will allow they are allowed to process the transactions. They will process the mandates, update the Aadhaar mapper. This destination bank will authorize or reject the mandate sent to them, and then will make the final settlement or the final payment as per the amount in the approved mandate. Users can be corporates, government departments, clearing times are there, settlement facilities there. These are the parties. Okay. What technology is primarily used in the Aadhaar enabled payment system transactions for authentication? Biometric authentication based Aadhaar, credit or debit card PIN for transaction authorization, mobile OTP verification, signature verification at the point of sale terminal. So, what is used for authentication of the AEPS transaction? Yes, A? Hmm. A is correct. So, it is a bank led model through which allows online interoperable financial transactions at POS through the business correspondent or business mitra. We need a KYC compliant bank account. It allows various services, cash withdrawal, cash deposit, balance inquiry, Aadhaar to Aadhaar fund transfer, mini statement. Okay, yes, A is correct. Then, which organization is responsible for driving the Bharat bill payment system with the authorization of RBI? NPCI, IBA, SEBI, or IFTAS? Basically, the central unit of the Bharat bill payment system. It is, yes, it is NPCI. All right, NPCI. So there are various participants in this Bharat bill payment system. We have the Bharat bill payment central unit, which is NPCI, responsible for setting the business standards, rules, procedures for technical and business requirement of the participants. Not B, not IBA, NPCI. NPCI has been authorized by RBI to drive the BBPS. Why will IBA be authorized? NPCI. All right. So all the payments are made through NPCI. Huh. Then we have the operating unit. Operating unit can be a bank or it can be a non-bank. Agent institutions are there, biller or utility companies are there. All right. What are the agents in the Bharat bill payment system? So who can act as an agent? Entities authorized by RBI to operate as the customer operating unit, customer touch points and service points, financial institutions providing the bill payment services, centralized units responsible for setting the BBPS standards. So we have already seen for setting the BBPS standards, we have NPCI. So D will be incorrect. Financial institutions providing the bill payment services, these are the operating units, either customer operating units or the billing company operating unit. Agents are the customer touch points and service points available in the various points. So agents are what? Business correspondents, they can be bank branches, collection centers, retail outlets. They are the agent. If we are talking about the operating unit, then we have the biller operating unit and the customer operating unit. A bank which integrates with either the customer is the customer operating unit or with the billers, so the biller operating unit. Or the bank can integrate with both as well. Clear? So please remember the BBPCU. BBPCU. Central unit is NPCI. Bharat Bill Payment Operating Unit BBP. Customer Operating Unit and BBP Biller Operating Unit. These are the banks and non-banks. Agents are the customer touch points which are going to help the customers. They will facilitate the customers in making the payments. All right, clear now? All the parties, all the participants in the Bharat Bill payment system clear? Yes? Once again. All right. So what happens in this Bharat Bill payment system? We have a bill payment system. The any individual they can pay their bills, electricity bill, water bill, gas bill, telecom using this particular system, right? So when I am using my mobile banking, point of sale terminal, mobile wallet, ATM, these are the channels through which I can make the payment. Now, who is going to set the standards, rules, and procedures? NPCI. NPCI will set the standards, so it is known as the central unit. The Bharat Bill Payment Central Unit is NPCI. Through it, all the transaction settlement facilities will be done. Okay. Then the next participant is the Bharat Bill Payment Operating Unit. Operating units are the bank and the non-bank. Now, operating units can be on the customer side or they can be on the biller side. The bank can decide they want to integrate with the customer, deducting payment from their side, or for the biller, crediting payment to the biller. Or if the bank decides, they can be the operating unit for both customer as well as the billers. All right. And then we have the agent institutions. Agent institutions who want to operate the customer operating unit, they want to help the customers in facilitating the transaction. So, business correspondents, collection centers, retail outlets, these agents will be present. to help the customers. Customer touch points and service points. That is all. Clear? All right. Okay. In terms of technology implementation in retail banking, what approaches are observed among the different types of banks? Foreign banks often use their own globally developed software. New generation private sector banks generally develop in house software. Public sector banks can use external vendors. Old generation private banks, they usually outsource. So, we are talking about the in house technology versus outsourcing. So, which type of banks use in house and which type of banks use outsourcing? B, one point that we remember, public sector banks, they generally use the in house facility. So we can eliminate the third one, right? We can eliminate the third one. New generation private sector banks, they should use outsourcing, right? They should use outsourcing. All right, generally, okay. Public sector banks, they generally use in-house sourcing, but they can also use external vendors for technology solutions. So this is correct. Public sector banks, they usually use the in-house sourcing, but for some products, they also have outsourcing, external vendors for technology solutions. Then the new generation private banks, they develop in-house software. No, they outsource. Foreign banks also outsource. They use their own globally developed software. And the old generation private banks, they have to use outsourcing due to their late entry. Yes, so the correct will be D, 1, 3 and 4. Yes, 1, 3 and 4. Hmm. All right. Which services were taken over by IFTAS from IDRBT and what were the significance? IFTAS took over which services from IDRBT? Infinet, SFMS, IBCC, NFS, Infinet, SFMS, Infinet, SMFS and IBCC, or NFS, Infinet and IBCC. So you only need to remember one thing. One of the four services was not taken over by IFTAS, rather it was taken over by NPCI. Do you remember? IDRBT had given four technology solutions. One of them was taken over by NPCI. For taking over other three, IFTAS was created, and IFTAS was also wholly acquired by RBI later on. Yes, great. 1 and 3. Great, Sharmila. Right. So, wait. NFS was not taken over, so 2 and 4 is incorrect, 1 and 3 is correct. All right. NFS was taken over by NPCI. When? In 2010. What are the key purposes of SFMS in the banking sector? To facilitate intra-bank and interbank secure messaging, to enable EFT and RTGS, to serve as a platform for high volume branch communication, to replace international messaging system like SWIFT. So what is the role of SFMS? Let us recall what we have studied about IDRBT. IDRBT was set up in 1996 on the recommendation of a committee chaired by WS Saraf. Four technology solutions are given: Infinet, SFMS, NFS, and IBCC. Then NPCI took over NFS in 2010. IFTAS was set up on the recommendation of Rangarajan Committee. Its headquarter is in Mumbai. Basically, it has taken over Infinet, SFMS, and IBCC in 2016. And then IFTAS was wholly acquired by RBI in 2019. And the role of SFMS is correct. Role is to facilitate intra-bank and interbank messaging, enable EFT and RTGS, and to work as a platform for high volume branch communication. But it works on the, or it is built on the same guidelines as the SWIFT, which is the International Financial Telecommunications Society. It does not replace it. So the correct answer will be A. It is a Indian standard similar to SWIFT. Okay. Which value added services are offered by NFS on the ATMs or cash deposit machines? Interoperable cash deposit and mobile banking, card to card fund transfer and checkbook request, statement request and Aadhaar number seeding, currency exchange and investment services. Value added services offered by the ATMs operating on the NFS system. A 1, 2, and 3. A, yes. Currency exchange and investment services are not offered. Currency exchange should be through authorized dealers only, authorized persons only, and investment services are not there. All right? Okay, 1, 2, and 3. So, yes, all the information about NFS ATM network I have given here as well as in this slide. Go through it. How does IDRBT's community cloud specifically serve the Indian banks? By offering a shared infrastructure exclusively for Indian banks, by offering specialized security and compliance features, by hosting consumer banking applications, by offering public cloud services. So, how does the IBCC work? IBCC. So, what are the services offered by IBCC? It offers a shared infrastructure exclusively for Indian banks, and it also offers specialized security and compliance features. Right? So the correct answer will be C. It is cloud computing is a promising technology which provides various services on demand over the internet. It is increasing, the demand is increasing. To furnish the cloud services, IDRBT has set up a approach, pilot approach in to build the community cloud for the Indian banks. So security controls, common objectives, these are offered. Consumer banking applications or public cloud services, these are not offered. Okay, so 1 and 2 right now, 1 and 2 only. Then what are some key characteristics of a moratorium or holiday period in loan terms? Borrowers are exempt from paying both principal and interest during this period. It provides borrowers with time to prepare for the upcoming repayments. Interest may still need to be serviced during the holiday period except in educational loans. It typically lasts up to 18 months for housing loans under construction. So, characteristics of the moratorium period. Yes, B, 2, 3, and 4. Correct. We do not have to repay the principal, but the interest is serviced here. The interest will be serviced, so 2, 3, and 4. How does a change in the interest rate affect a loan with an EMI repayment structure? It leads to a change in the EMI amount while keeping the loan tenure the same. It necessitates a recalculation of the EMI using the new interest rate. It results in a change in the tenure of the loan while keeping the EMI amount constant, or it has no impact on the EMI or the tenure of the loan. So, how does the reschedule, a change in the interest rate, impact the EMI repayment schedule? D, yes, the correct answer will be D. All right, A is not true. Why? First statement is not correct. It leads to a change in the EMI amount while keeping the loan tenor the same. We try to pay the higher EMI if the interest rate is changed, or we try to do what? We recalculate the EMI, right? And it also changes the tenor. The loan tenor is not kept the same because it won't be possible for the customers to pay the increased EMI in the same time. So that is why we need to recalculate it. All right. What distinguishes a genuine default from a willful default in the loan repayments? Genuine defaults occur due to unforeseen personal or business setbacks. Willful defaults are characterized by borrowers' deliberate choice not to repay. Genuine defaults are always forgiven by banks requiring no payments. Willful defaults occur exclusively in the high value loan segments. So genuine defaults are where the customer, they are unable to pay due to a genuine reason, right? Willful where they have the capacity to pay but they are just wanting to create a fraud. So yes, D. 1 and 2 only. 1 and 2 only. All right, genuine defaults are not always forgiven. In some cases, they can be forgiven. Okay. How are special mention accounts classified in the context of loan account monitoring? SMA 0 overdue by 1 to 30 days, SMA 1 overdue by 31 to 60 days, SMA 2 overdue by 61 to 90 days, SMA 3 overdue for more than 90 days. So, what is the classification for the special mention accounts? Huh. So, we have three categories: SMA 0, SMA 1, and SMA 2. When the interest or the principal has remained unpaid for this period, right? So, the correct answer will be A. SMA 3 is not there. If the overdue is for more than 90 days, then it will enter in the substandard asset category. Substandard asset. All right. What are the criteria for classifying an asset as a non-performing asset in the banking sector? A term loan where interest and or principal remains overdue for more than 90 days. An overdraft or cash credit account remaining out of order for more than 30 days. Bill purchased and discounted remaining overdue for more than 90 days. Any loan where the borrower has declared bankruptcy or insolvency. Yes. 1 and 3 only. Second statement is not correct because here also we take 90 days. If the overdraft or cash credit account remains out of order for more than 90 days. All right? For more than 90 days. And fourth statement is obviously incorrect. So 1, 2 and 1 and 3 only. Not 1, 2 and 3. No. A is not correct. Hema, here it is given 30 days. It should be 90 days. Hmm. D. All right. What defines a substandard asset in the banking sector? An asset that has been non-performing for a period of less than or equal to 12 months. Asset with significant erosion in the value of its security. Asset with well-defined credit weakness that could lead to potential losses. An asset that has remained NPA for more than 12 months. For more than 12 months. So how do we classify a substandard asset? A substandard asset. Yes, so the correct answer is C, 1 and 3 only, right? Asset with significant erosion in the value of the security is a loss asset, right? Which means that the realizable value of the security is less than 10%, right? So then it will be classified as a loss asset. And the asset which has remained non-performing for more than 12 months, no. All right. Less than 12 months is a substandard asset. More than that, it will enter into the doubtful category. All right. How are the doubtful category assets classified? Doubtful 1, non-performing up to 12 months. Doubtful 2, non-performing more than 12 months but less than 3 years. Doubtful 3, non-performing for more than 3 years. Loss asset considered uncollectible with no salvage value. So what is the categorization for doubtful? Actually, this should be asset which has remained in the doubtful category for up to 12 months, in the doubtful category for more than 12 months, and doubtful category for more than 3 years. This should be the correct statement, right? So loss asset is after it. It does not come in the doubtful category. So the correct statements should be if it is given doubtful, then A. 1, 2, and 3. All right? 1, 2, and 3. Asset which has remained in the doubtful category for up to 12 months is a doubtful category 1. Asset which has remained in the doubtful category for more than 12 months up to 3 years. Doubtful category 2. An asset that has remained in the doubtful category for more than 3 years, that is a doubtful category 3. Loss asset is considered uncollectible. Alright, so the correct answer will not be B, it will be A. Alright. What are the provisioning requirements for the different categories of the NPA? Loss assets should be either written off or 100% provisioned. Substandard assets require a general provision of 10% on the total outstanding. Doubtful assets for up to 1 year require 25% provision of the secured portion. Standard assets do not require any provision. So regarding provisioning, which statements are correct? A, The correct answer is yes, D. Substandard asset require a general provision of 15%, not 10% but 15%. Loss asset 100%, doubtful asset up to 1 year 25%, up to 3 years 40%, more than 3 years 100%. Substandard asset a general provision of 15% without making any allowance for the securities available. Additional 10% will be there. Additional 10% for the unexposed unsecured exposure. All right, so here it will be 15%. So 1 and 3. All right, what are the provisioning norms for standard assets in the retail banking sector? Standard assets. Farm credit and SME sector loans require a 0.25% provision. Commercial real estate loans require 1%. Residential housing sector sanctioned after 7th June 2017 require 0.25%. All the other loans and advances require a 1.5% provision. So now we are talking about the standard assets. Again, farm credit 0.25 is correct. Commercial real estate sector is at 1% provision. Residential housing in the commercial real estate is what? It is not 0. Or all right, after 7 June 2017 it is given, so 0.25. All other loans and advances, do they require 1.5? No. They attract 0.40% of provisioning. So the correct answer is 1, 2 and 3. All right. A is correct. 1, 2 and 3 is correct. Not D. All right. Farm credit 0.25, advances to the commercial real estate 1%, commercial real estate in the residential housing sector 0.25, housing loans after 2017 0.25, and all other loans 0.40%. Okay. What are the key components of the SARFAESI Act? Provision for the securitization mechanism for reconstruction, mandate for banks to seek court approval before seizing assets, recognition of security interest for the purpose of loan repayment. What are the key components under the SARFAESI Act? Key components. There is a provision for securitization. Reconstruction is also there. Banks, they can also create security interest. But all of this can be done without the court approval. So correct answer will be C, 1, 2 and 4. Yes. Third statement will be incorrect. All right. So reconstruction, recognition of any security interest, securitization, power to enforce such security, everything is there. Then what are the eligibility for initiating the SARFAESI Act? Outstanding in the account, including the loan, should be more than 1 lakh. Loan must have been classified as NPA. The outstanding dues should be 20% and above. Secured asset should not be agricultural land, and so on. Okay. What conditions must be met for a loan account before action can be initiated? Just we discussed. So the loan account must be classified as NPA with no security backing. Outstanding dues in the account should be 1 lakh or more. The secured asset should be agricultural land. The outstanding dues should be 20% or above of the principal and interest. So what conditions must be met? Yes, B only. 2 and 4. It must be classified as an NPA, but it should have a security and it should have been registered. A charge has been registered. All right, and it should not be an agricultural land. So 2 and 4. What is the minimum outstanding amount required for the initiation under the SARFAESI Act? This also we have already seen. Minimum outstanding is, what is the minimum outstanding? 1 lakh rupees in the account. Correct. 1 lakh. All right. What are the requirements for filing an appeal against the DRT's order? So all of these actions the bank can take without seeking the court approval. If any person is aggrieved by any of the actions taken by the bank, they can approach the DRT and make an appeal. If they're still aggrieved by the DRT's order, they can take a higher appeal to the DRAT. So, what are the conditions for filing an appeal against the DRT's order? Appeal can be filed without any conditions to the appellate tribunal. Appeal must be filed within 30 days. A deposit of 75% is to be done. The DRAT can reduce the deposit up to 25%. C, yes. So the correct answer is C. This deposit is not of 75% but 50%, right? And the appeal, it requires this condition. You have to make a deposit of 50%, only then you can make an appeal to the DRAT. Okay. What are the criteria for a debt case to be eligible for application to a DRT? The amount of debt due must be less than 20 lakh. The amount of debt due must be 20 lakh or more. Multiple banks can join an existing application. The application can only be made for secured debts. Now we are talking about the recovery of debts due to banks and Insolvency Act. So here in the SARFAESI, the banks can directly take action. They have also another option. They can take the case to the DRT. So what is the criteria for taking the case to DRT? The amount of debt must be rupees 20 lakhs or more. And yes, multiple banks can join an existing application. So if a bank has already made an application, other financial institutions also come in front and they say that this customer also owes us due. They can also join the same application. All right. And in the SARFAESI Act, it was there that the application can be made only for the secured debts. In this one, that is not true. Okay. What is the legal status of an award made by the Lok Adalat? Now, Lok Adalat, easiest, fastest mode of getting the less than 20 lakhs is Lok Adalat. Lok Adalat works on the principles of justice, equality, and they try to bring a reconciliation and mediation. So the award passed by the Lok Adalat is deemed to be a decree of civil court and no appeal can be made against the order passed by the Lok Adalat. Appeal can be made against the order passed by the DRT, but not against the order of the Lok Adalat. All right. Why? Because it has been arrived with the mutual consent of both the parties. How are investors repaid in a securitization structure? So, what happens in the securitization? The originator, who is the bank, the originator creates a pool of assets, sends it to the SPV, right? The SPV issues security receipts to the investors. SPV makes a direct payment to the originator. How do the investors get this repayment? Through the stock dividends, via fixed income from the government, through capital gains on the securities, from principal and interest cash flows of the underlying debt. Here we are talking about when the standard assets are given or transferred to the SPV. The SPV is going to collect the principal and interest. So the obliger, obliger will directly pay the amount to the SPV. Yes, the correct answer will be D. All right, from the principal and interest cash flows of the underlying debt, now the investors will get their payment. Okay. In the RBI's master direction on securitization, what are the stipulations regarding the minimum retention requirement? MRR of 5% for the loans with original maturity of more than 24 months, 10% for less than 24 months, 5% for residential mortgage-backed securities, irrespective of maturity, no MRR requirement for loans with bullet repayment. So, what is true about the minimum retention requirement? So, for up to 24 months or less, it is what? It is 5%. More than 24 months, it is 10%. Huh, correct. And MRR for the residential mortgage-backed securities will be 5%. Even for the bullet repayments, 10% of the book value is there. All right, 10% of the book value for the bullet repayments. Which of the following statements are correct regarding the minimum holding period for the different repayment frequencies of loans? For weekly repayment frequency, MHP for original maturity up to 2 years is 6 installments. MHP for loans with more than 5 years maturity is 12. Quarterly repayment frequency, so the whole table. There's the whole table regarding the MHP that we have seen. From that, you need to answer. All right. So the first statement says for weekly repayment frequency, MHP for the loans with original maturity up to 2 years is 6 months. So original maturity is 2 years. We are talking about what? We are talking about weekly repayment frequency. So it is what? It is 12. It is not 6 installments, it is 12 installments. All right. Then for monthly repayment, MHP with the maturity 5 years. Maturity up to 5 years, monthly repayment. Then we are talking about 6 installments. Okay, more than 5 years. Huh. More than 5 years is 12 installments. Okay. The question is saying more than 5 months, so it will be 12 installments. So, second statement is correct. Quarterly repayment frequency for up to 2 years. What do we require? Quarterly for 2 years, then two. This is two installments, so three is also correct. Fortnightly repayment for loan 2 years to up to 5 years is nine installments, right? Fortnightly repayment capacity from 2 years up to 5 years should be nine installments. So, 2, 3, and 4 should be correct, right? 2, 3, and 4 is not given to us. 2, 3, and 4 should be correct. More than 2 years, up to 5 years, fortnightly, if the payment is done, then 9. So, 2, 3, and 4 will be correct. So here you have the table. Let us see. Loan maturity up to 2 years, from 2 years to 5 years, fortnightly is 9 installments. All right. So 2, 3, and 4. Similarly, for up to 2 years, weekly is 12, fortnightly is 6, monthly is 3, quarterly is 2. 2 years to 5 years, 18, 9, 6, and 3. More than 5 years, we are allowed only monthly and quarterly. So 2, 3, and 4 will be there. Okay. Which assets are ineligible for transfer under the RBI's guidelines for securitization by direct assignment? Securitization by direct assignment, which assets are ineligible? Single standard assets, revolving credit facilities such as the credit card receivables, assets with bullet repayments of both principal and interest, portfolio of standard asset. Portfolio of standard asset. Ineligible, not allowed. Standard assets is allowed. We can transfer standard assets. We can also transfer portfolio of standard assets, right? But revolving credit facilities, assets with bullet repayment, these are not allowed. So the question asks us which are not allowed. So B, 2 and 3. Ineligible. You are telling me the eligible ones. Ineligible. Which assets are ineligible for transfer under the securitization by direct assignment? So revolving credit facilities and bullet repayment assets are not allowed. B, 2 and 3. All right. B is correct. What are the key functions and features of the NARCL, National Asset Reconstruction Company Limited? NARCL was incorporated with the objective of providing additional capital to banks. It has the mandate to acquire stressed loan assets supported by a government guarantee. Public sector banks hold a majority stake in the NARCL. NARCL is responsible for direct resolution of stressed assets. So, what is the responsibility of NARCL? Right. C. Okay. 2 and 3. C is correct. It is a bad bank incorporated in 2021. Authorized capital of 2,750 crore. Paid up capital. What is important here? The public sector banks will have 51% shareholding. Remaining will be the private sector. In the IDRCL, the 51% shareholding will be with the private sector. Okay. A newly launched fintech company is struggling to gain traction in the market despite having a competitive product. Their early customer feedback suggests that while the service is innovative, their messaging is unclear and their pricing structure is not aligned with the customer expectations. So the company's leadership is uncertain about how to proceed and is debating whether to revamp their marketing strategy or entirely they make the targeted adjustments. So, as the marketing consultant, which stage of the marketing process should the company prioritize first to resolve these issues effectively? If the institute is not, their product is good, it is innovative, but it is still not able to gain profit, then where is the issue? In the marketing implementation stage, marketing control stage, planning stage, or marketing analysis stage? The question says that their messaging is unclear and the pricing structure is not aligned with their customers' expectations. So their plan is wrong. They have done the wrong planning. They understood the market. That is why they created an innovative product. But they did not advertise the product. They did not think about the right price for the product. How is the product going to reach the customer? They did not discuss enough about it. So it is a issue in the marketing planning stage. All right, issue in the marketing planning stage. Clear? Why C is correct is clear. If the product was not innovative or the customers were not demanding it, then it would be market analysis. Market control would have been if the customer feedback was not positive. But the customer is saying that the product is innovative. All right, so C. And whatever happens in each of the stage, this we have given. What happens in the marketing analysis, in the marketing planning, in the marketing control. Thank you, sir. Rajiv sir is here to wish you all the best. Thank you, sir. All right, let us move on to the next question. What are the primary roles and differences between the business correspondents and the business facilitators? Both business correspondent and facilitators are allowed to make transactions. The business correspondents can make transactions on behalf of the bank. Business facilitators, they facilitate the bank in carrying out the transaction. Business facilitators are authorized to perform the loan recoveries and account openings. Business correspondents serve as agent of the bank, and business facilitators, they refer the clients and facilitate transaction without personally conducting them. So what will be the correct answer for this? We are left with a few more questions, half an hour more, and then we will end the session. Just half an hour more. So business correspondents, they act as agent of the bank. Yes, they can carry on transactions. Business facilitators, they are representatives, right? They will only refer the customers, advise the customers, but they will not transact on behalf of the bank. All right. They will not transact on behalf of the bank. So the correct statements will be 2 and 4. 2 and 4. Okay. Only business correspondents are allowed to make transactions on behalf of the bank. They are authorized to conduct loan recoveries and account openings also. But business facilitators will only serve as the agents. They will refer the clients. They will refer the clients and facilitate the transaction. They will not personally conduct the transactions. Okay. What are the white label ATMs and who operates them? These are operated exclusively by government banks. They are ATMs set up, owned, and operated by the non bank entities. White label ATMs provide banking services based on cards issued by the banks. Non bank entities need to establish connectivity with the shared ATM operators. So, which statements are correct about the white label ATMs? B is correct, right? Non bank entities set up, own, and operate the white label ATMs. They also provide banking services, but they're not exclusively run by the government banks. We have the on-site ATMs, off-site ATMs, everything which is given. On-site ATMs are attached with the bank branches, off-site ATMs are located away from the bank branches. Okay. How do point of sale terminals differ from the ATMs in their functionality? They are predominantly used for multiple banking services, including cash withdrawals. They can be used for services like balance inquiry, unlike the POS terminals. POS terminals and ATMs both are primarily used for cash withdrawals. POS terminals are primarily used for payment transactions in sales and purchases. So, correct statements about the difference between POS and ATMs. D, yes, D is correct. All right. ATMs, the POS cannot be used for multiple banking services, mainly for payment transactions in sales and purchases. And ATMs, they perform the various multiple banking activities. What is the transaction limit for the *99 hash service and how is it accessed? The transaction limit is 10,000 per transaction. Users can access the banking services by dialing this number or any GSM set. The service requires the installation of a specific banking app. The upper transaction is 5,000 per transaction. So, what is the limit here? What is the limit and what are the other features? Yes, so the customers can access it by simply dialing it. We do not require a specific banking app, and the upper limit transaction is 5,000 per transaction. So the correct answer will be 2 and 4. All right, 2 and 4. Okay. What are the bank's responsibilities in the case of an unauthorized electronic banking transaction? The bank must credit the amount involved in the transaction within 5 working days of the notification. Banks are required to resolve the complaint and establish the customer liability within 90 days. The bank has the burden of proving customer liability. The banks must credit the shadow reversal amount within 10 working days of notification by the customer. So, what is the correct answer about the unauthorized electronic bank transaction? No, not B. 3 is also correct, right? Who has the burden of proving the customer liability? This lies with the bank. Whatever liability that the customer has, this has to be proved by the bank itself in the case of unauthorized transactions. All right? And the shadow reversal is to be done within 10 days, not 5. Liability of the customer will be proven by the bank. Where will be their zero liability? If it is a third party breach, neither with the customer nor with the bank, and the breach or the fraud or unauthorized transaction is because of the bank's fraud, negligence, or deficiency. If, let's say, the unauthorized transaction was due to the negligence of the customer, then there will be the entire loss will be borne by the customer until and unless they report it to the bank within 4 to 7 days. Okay, if they report it to the bank, then after all of those after the reporting the transactions that are there, bank will bear the responsibilities. And if there's a delay between 4 to 7 days, then the liability will be limited. It will be decided by the bank themselves. All right. Okay. What is the timeline and compensation for auto reversal in the ATM transactions where cash is not dispensed but the account is debited? Auto reversal between T plus 1 day with 100 rupees per day compensation beyond T plus 1 day. Proactive reversal of the failed transaction within a maximum of T plus 5 days. 100 rupees per day of the delay beyond T plus 5 days. And auto reversal is not applicable. Yes. So maximum time is T plus 5 day and compensation is what? 100 rupees for each of the day when there is a delay. All right. Okay. What about the recredit of the amount or auto reversal in the case of Aadhaar enabled payment system? The acquirer must initiate a credit adjustment within T plus 5 days. Compensation of rupees 50 per day if the delay is beyond it. 100 rupees if the delay is beyond T plus 5 days. Auto reversal if not is not applicable in the AEPS. So what is the auto reversal here? In the Aadhaar enabled payment system. It is same, right? Compensation, it should be done within T plus 5 days and compensation is rupees 100. So B, yes. For the Aadhaar enabled payment system also it is the same. T plus 5 days and 100 rupees if the delay is beyond T plus 5 days. Okay. What is the impact of adopting the code of bank's commitment to customers on other voluntary codes of IBA? It makes the other voluntary codes inapplicable to the members. It requires all the banks to follow the fair practice code for credit cards, regardless of their membership. It continues the application for the repossession of security. Non BCSBI members can continue to follow the IBA rules. So when the IBA's two codes are there, code of bank's commitment to the customers and code of bank's commitment to the MSMEs, right? The BCSBI codes. So if the bank voluntarily adopts the code because it is a voluntary, it is not mandatory. So it will make other voluntary codes inapplicable and those who are not the members will have to continue to follow these codes. So the correct answer will become D. All right, so the codes that they do not have to follow: bankers fair practice code for the credit card operations, and model code for the collection of dues and repossession of security. All right, now we are here in the module D. So quickly match the following bond types with their characteristics: regular convertible, floating rate, zero coupon bonds, and retail bonds. Quickly answer. What should be the correct answer? What will be the correct answer? C, yes. So regular convertible bonds are what? It gives the investor merely the right, not an obligation. Floating rate, variable interest, zero coupon, do not earn any interest, and retail bonds that typically listed can be bought and sold during the regular market hours. Right? So regular where the right is with the investor, mandatory obligation with the investor, they have to convert it into the shares upon maturity. Reverse convertible. Now the issuing company holds the right to convert the bonds into equity shares. All right. What are the characteristics of bonds? Bonds are derived from the loans forwarded by the borrowers. The issuer of a bond promises to pay a specific interest for the bond's life. Bonds are not tradable and cannot be bought or sold. Bonds are typically issued by the governments, corporations, and municipalities. So, which are the characteristics of bonds? Which of the following are characteristics of bonds? B. 2 and 4. 2 and 4. Yes. B is correct. Not C, but yes. B is correct. So, issuer of the bond promises to pay a specific interest. It is a debt instrument and they are issued by the government, corporations, and municipalities. Okay. Which government bonds are indexed in accordance with the CPI or WPI? Very simple. Indexation is used in which type of bonds? Fixed rate, sovereign gold bonds, inflation indexed, or 7.75% Government of India savings bond, inflation indexed. Right? So the interest rate will be determined on the inflation, the current inflation trends. I have given you all the types of government bonds, floating rate bonds and their characteristics, inflation indexed, then the sovereign gold bonds, 7.75% Government of India bonds, everything. What are the two main types of municipal bonds in India? General obligation bonds and fixed rate bonds, revenue bonds and zero coupon bonds, municipal bonds and retail bonds, general obligation and revenue. What are the types of municipal bonds which are issued in India? D. Yes, we have the general obligation bonds and the revenue bonds. Right? General obligation for more than one projects, revenue bonds for some specified projects. All right. What are the key features of the equity linked saving schemes in India, ELSS? So now we are talking about the various schemes under Section 80C where we can claim the deductions. So the investments are locked for a minimum of 5 years. These funds offer immediate tax benefits under Section 80C. They are open-ended funds. They have a lock-in period of 3 years. Features of ELSS. Yes. So they offer immediate tax benefits, but they have a lock-in period which is 3 years. The investment mates are exempted from income tax. All right. So the types of schemes under Section 80C: equity mutual fund, debt mutual fund, balance, sectorial, open-ended, and closed-ended. All right. What services do the investment banks provide in mergers and acquisitions? So here we need to differentiate and understand the difference between investment management and investment banking as well. Investment management is for those the who have surplus funds with them and they want to better manage those funds and earn an interest. Investment banks, they go with mergers and acquisitions. So directly managing the operations of the company involved, advising on the valuation and structuring of delays, facilitating the legal proceedings of the merger or acquisition, underwriting the securities involved in the transaction. Which services are offered by the investment banks in the mergers and acquisitions? Legal proceedings are not a part of the services offered by the investment banks. They advise the corporations for the valuation and structuring. They also provide underwriting securities, but legal proceedings or directly managing the operations, this is not provided by the investment banks. So C will be incorrect. 2 and 4 only. 2 and 4 only. All right. So activities provided by the investment bank, these are given. Okay. Which statements correctly describe the investment management? Investors are those who have surplus money than they need for the immediate consumption. Investment has two elements, namely time and risk. In the investment process, present consumption sacrifice is certain and getting a return in the future is certain. So, which statements are correct? 1 only, 1 and 3, 2 and 3, 1, 2 and 3. So, for the investment management, which statements are correct? Investors who have surplus money than they need for immediate consumption, correct? Then investment has two elements, time and risk. No, it has more than that. Investment has many elements, return is there, safety is there, security is there. Also, the investment, the return is not certain. So the correct answer will be A, 1 only. All right, the present consumption which is sacrificed is certain, but getting a return in the future will be uncertain. It will depend upon the ability. Yes, there will not be a return. Okay, getting a return will not be certain. Okay. Select the statements that are not right about investment management fee. Management fee is usually a percentage of the value of the portfolio held by a client. Fees are typically on a sliding scale. The more assets a client has, the higher is the fee. Management fees may vary from 0.5 to 2% annually. The average management fee is around 2%. So this is as per the new regulations given by SEBI. New regulation given by SEBI. So in the portfolio management, apart from the management fees, banks they also the investment management they also charge operational fees. So management fees is fixed, right? But the operational fees it varies somewhere between 0.5% of the AUM. All right. So the statements which are correct here are fees are typically on a sliding scale. More assets, asset under management, higher will be the fee, and the average management fee is around 3%. All right, so the correct answer will be D, 2 and 4. 2 and 4. Other than that, no upfront fees will be charged. Operational fees cannot exceed 0.5%. Maximum exit load we have seen. If you exit the services in 1 year, then 3%, 2 years, 2%, and then more than that, 3 years, it will be 1%, and more than 3 years, 0. All right. There are generally three types of underwriting. Which of the following is not one of them? Firm commitment, best efforts, half of the price, or all or none. All or none is not a type, right? Firm commitment is where the underwriter, if let's say out of 100 issues, 100 shares are issued and only 90 are sold in the underwriting service. So firm commitment means the remaining 10 will be purchased by the underwriter. Best efforts means the out of 100, 90 are sold, 10 will be returned. all or none means if even one remains unsold, then the entire deal will be called off. So these are the three types. Then regarding the types of portfolio management services, differentiate between the discretionary and non-discretionary management. In discretionary management, the portfolio manager has complete control over investment decision. In non-discretionary, the management requires investors to make the final call. Discretionary PMS typically incurs lower fees. Investors in the non-discretionary receive investment suggestions. So what will be correct? Yes. Discretionary PMS involves more fees as compared to the non-discretionary because there is higher involvement. Now, regarding the SEBI's new guidelines, already we have seen which of the following statements are correct. No upfront fees can be charged. This is true. Operational fees excluding brokerage cannot exceed 1%. No, it will be 0.5%. Exit load 3% in first year, 2% in second year, 1 in third year. No exit load is applicable after 3 years. So, two option 1, 3 and 4, right? Yes, 1, 3 and 4 should be correct. B, 1, 3 and 4. Not C, the operational fees cannot be more than 0.5%. All right. Is the principal portion of a home loan EMI eligible for tax reduction or not? Yes, under the section 80C up to 1.5 lakhs. Yes, under section 24 up to 2 lakhs. No, only the interest portion is eligible. Or under section 80EE up to 50,000 rupees. So is the principal portion deductible or not? So yes, it is deductible under section 80C up to 1.5 lakhs. Okay. Under what circumstances is the capital gains tax not applicable? When a property sold after being held for more than 36 months, when there is only a transfer of property and no sale, as in the case of inheritance, when the asset is a primary residence, when the asset is sold at a loss. So, in which of the following cases the capital gains tax will not be applicable? B, correct. If we have just received the property without any consideration, then there will be no capital gains tax. How is the index cost of acquisition calculated? So when we are calculating the long-term capital gain, how do we calculate the index cost of acquisition? Multiplying the cost of acquisition with the CII, cost inflation index of the year of transfer, dividing it by adding the CII or by subtracting. Multiply? Yes. So we multiply the cost of acquisition. So whatever price we have paid to purchase the asset multiplied by the cost inflation index of the year in which we are transferring it. So we will get the index cost of acquisition. State whether the following statements about RBI's guidelines for the mutual funds are true or false. Banks shall not undertake the mutual fund business with risk participation in any case. The purchase of units shall be at the customer's risk without the bank guaranteeing any assured return. No mutual fund units shall be acquired from the secondary market or bought back from a customer for selling it to another customer. So, whether these statements are true or false. So, the first statement is false because they can undertake this business with risk participation through a subsidiary. The profits of the units will be at the customer's risk. This is true. And the banks, they have to keep their accounts separate. They cannot provide any guarantee, nor they can buy back from the customer or sell it to another customer. So it will be false, true, and true. First statement is false, second and third statement is true. All right. If banks want to undertake insurance business with risk participation through a subsidiary or a joint venture, then what should be the net worth? Rupees 1000 crores, rupees 500 crore, 2000 crore, or 1500? What should be the net worth if they want to take the insurance business with risk participation? Yes, it is rupees 1000 crore. Ins- and broking business through the subsidiary, then 500. All right. What are the provisions under the Pradhan Mantri Jeevan Jyoti Bima Yojana? Eligibility age group 18 to 70 years. Benefits 2 lakhs payable on the member's death due to any cause, closure of account with the bank, or insufficiency of balance will terminate it. So, what are the provisions under the Pradhan Mantri Jeevan Jyoti Bima Yojana? Under the Pradhan Mantri Jeevan Jyoti Bima Yojana, the eligible age group is not 18 to 70. It is what? It is 18 to 50 years. Yes, it is 18 to 50 years. In the Suraksha Bima Yojana, it is 18 to 70 years. Other two statements are correct. Yes, C will be the right answer. Okay. Select the correct statements about depository services by the banks. Some banks have been offering the depository services through NSDL and CDSL. The depository participant is an agent of the depository authorized to offer the depository services. International Securities Identification Number is a unique 10-digit numeric code. So banks, they act as the depository participant and as an agent of the depository as well, but they have to be registered not with RBI but with SEBI. Right? Their registration should be with SEBI. Moreover, the ISIN number is not a numeric code, it is an alphanumeric code. Alphanumeric. So the first two digits will be the identification of the nation. So in India, it will be IN, and then the 10 will be what? The remaining 8 will be the numeric. So only one is true. Only one. Yes, one is true. Okay. What is a unique feature of the money back policies in life insurance? The policyholder receives a lump sum after a specific term or on death. The full sum assured is paid only in the event of critical illness. They are most suited for the senior citizens planning for a secure future. The policyholder receives a fixed amount at specific intervals. Right. So the policyholder receives a lump sum after a specific amount or death. This will be what? This will be a feature of our endowment policies. But when we are talking about money back, so the policyholder receives a fixed amount at specific intervals. All right. What are the criteria for a bank to set up a subsidiary or a joint venture for an insurance broking? For insurance broking, they are setting up the subsidiary. The net worth should be at least 1000 crore. Minimum prescribed capital after investment should be maintained. The bank must have a good track record of profitable operations. The bank's net worth should not be less than 500 crore after investing in the subsidiary's equity. So this criteria of the minimum net worth of 1000 crore is when they are setting up the subsidiary. for participation with risk, risk participation. But here only for the broking services. So 2, 3, and 4. Okay. What are the redemption terms for the sovereign gold bonds? Premature redemption is permitted from the fifth year on the interest payment dates. Bonds are redeemable only upon maturity after 8 years. Redemption price is based on the gold price at the start of the bond tenure. Redemption is done in the physical gold. So, what is allowed in the sovereign gold bonds? Sovereign gold bonds. Wow, just a second. All right. So, the correct answer is option A. Premature redemption is permitted from the fifth year. Premature redemption is allowed in the case of sovereign gold bonds. This is there. All right, so A will be correct. Only on maturity, this is not true. They are repayable on the expiration of 8 years. That is true. But only on maturity will be not correct. Then the redemption price is not based at the beginning, but we determine it in the last 3 days. And the redemption is not in physical golds, but we will do it in the cash. All right. Last few questions, just last few questions. Bear with me, and then we will end. What are the tax implications for investment in the sovereign gold bonds? Interest on the sovereign gold bonds is fully tax exempt. Capital gains to an individual is exempted. TDS is applicable on the bond. Indexation benefits are provided to the long term capital gains. We have just 6 more questions remaining today. 6 more questions after this. So here the correct answer is B, 2 and 4. The capital gains on the redemption is exempted and the indexation benefits are there. All right. Let us answer some scenario type questions to determine the residential status. All right. Just these scenario questions. So Mr. Sharma, let's say has a fixed deposit of rupees 5 lakhs with 7% annual interest rate for 5 years, which is compounded quarterly. If he prematurely withdraws after 3 years, the bank applies 1% penalty on the applicable interest rate. What is the effective interest rate that he will receive on the premature withdrawal after 3 years? 6%, 7%, 5.5%, or 6.5%? So premature withdrawal is done. Penalty is 1%. Interest rate offered was 7%. So what does the bank do in the premature withdrawal? They will deduct the penalty and offer 6% for the premature withdrawal. Yes, 6% is applied. All right. Let's say Neha sells her ancestral land and earns a long term capital gain of 80 lakh rupees. She invests 75 lakhs into purchasing a new residential house property within 2 years after the sale. The remaining 5 lakhs is retained in her savings account. What will be the exempted capital gain under section 54F? So she has not invested the whole capital gains into purchasing a new residential house. Will she get the exemption of 80 lakhs, 75 lakhs, 5 lakhs, or no exemption? No, actually, the correct answer will be D. Why? Because under the section 54, the entire sale consideration and not just the capital gain must be reinvested in to claim the exemption. Yes, D. No exemption will be available here because you need to reinvest the entire sale consideration. Okay, so entire 80 lakhs should have been reinvested for all the sections under 54. All right. Samir sells his house property and earns capital gain of 60 lakhs. He reinvests 50 lakh rupees into the government approved bonds within 5 months after the sale and keeps the remaining 10 lakhs. How much will be exempt under section 54 EC? So now we are talking about a different section. Under the section 54F, the entire amount has to be reinvested. The section 54 EC, however, says that only up to 50 lakhs you can claim the capital gains. The limit is 50 lakhs. So even if anyone reinvests the complete amount, more than that, less than that, it won't matter. Maximum is what? Maximum is rupees 50 lakhs. Only up to 50 lakhs of the capital gain can be reinvested into the specific bonds. Now answer this question. You need to determine the residential status. Yes, C was correct. Okay. Ramesh, an Indian citizen, has been working abroad and returns to India for 150 days in the financial year. His total stay in India for the preceding 4 years is 400 days. What will be his residency status for the tax purpose? Indian citizen but has gone outside of India for 150 days. In the preceding 4 years, they are here in India for 400 days. So, what will be the residential status? Whether they will be considered as a resident, non resident, not ordinarily resident, or deemed resident. What are the criterias? Either you have to stay in India for 182 days and preceding 2 years, 365 days, along with 60 days in the relevant financial year. But here, neither of the condition is being fulfilled. They're not living for more than 182 days, right? Plus, in the preceding 2 years, it should be more than 365 days. This is the criteria. None of these are being fulfilled, so they will be treated as a non-resident. Ramesh does not meet either of the two criteria as his stay in India during the relevant financial year is less than 182 days and his stay in the preceding years is not above 365 days. Okay. Shweta, who is an Indian citizen, has been living in Dubai and earns 30 lakh annually from her business in India. She does not pay tax in Dubai or any other country. What will be her residency status now? So she is a resident of India, of Dubai, but 30 lakh rupees she is earning from India. So what will be her status? What will be her status? So we said that if an Indian citizen who is not liable to pay tax in any other country, but their total income, excluding the foreign sources, exceeds 15 lakh rupees, they will be considered as a, no, not as a resident, deemed resident. Yes, they will be required to pay taxes, but will be considered as a deemed resident. So she will be considered as a deemed resident. All right. Amit, an Indian citizen, has lived outside India for 10 years, returns to India in the financial year and stays for 185 days. However, he has stayed in India only for 100 years in the previous 4 years. Now, what will be the residency classification? Will they be considered as a resident, not ordinarily resident, non-resident, or deemed resident? First criteria is satisfied. They have qualified as a resident by staying more than 182 days. But the second criteria is not satisfied. Second criteria, he does not meet the additional criteria. So he will not be a resident. He will be considered as a resident, not ordinarily resident. Again, revise the whole table that we have discussed in yesterday's capsule batch. The classification. They will be a resident, not ordinarily resident. Last question for today. Amit takes a home loan of rupees 50 lakhs and the bank issues a demand draft in favor of the builder. Later, the bank finds out that the draft was encashed by an agent rather than the builder. What should have the bank done to mitigate such frauds? Issue the draft in Amit's name, credit the loan amount directly to the builder's verified account, disburse the loan in cash to avoid the encashment issues, allow Amit to handle the encashment process independently. So bank has already issued a demand draft in favor of the builder. Later on, it was found that it was encashed by an agent. So yes, to avoid such a situation, the bank should credit the loan amount directly to the builder's verified account and not do anything else than that. Finally, we are done. We have completed all the modules, all the important topics, and that is all. So, final revision is done. And what you need to do now, if you want to revise still, simply download the PDF, go through the explanation points that are given. Nothing more than that is important. All right, we have practiced around 200 questions today, and these are more than enough for you to qualify the exam. So now I will see you after your exam, after all of your shifts, and then we will discuss how was the paper, how much you scored, and I know all of you are going to qualify the exam with very good marks. So now I will see you tomorrow. And obviously, I'm there on the WhatsApp group. Still, if you come across any doubt, I'm available to answer your queries. So, all the very best to all of you. Best of luck. Do your best. Have faith in your preparation. Be confident. And we will celebrate the success together. All the best, everyone. Now, take a good night's sleep and wake up with a fresh mind and then give your exam. Take rest now. Good night, everyone. Thank you.